Hello and welcome to AJ Bell's Multi-Asset Seminar. My name's Danny Hewson and I'm delighted to be your host. Similar to the in-person events that we ran recently, I'm really happy to join you today to ensure that proceedings run smoothly. While our physical events are back in business, and it's just been brilliant to see so many people joining us, we do understand that it's very convenient to be able to have the content delivered directly to your screen. So for those of us who missed the coffee and the networking, we're delighted you could join us today virtually. And I promise you that the quality of our speakers remains first class. And I'm confident that you will find each of the talks of interest. Please feel free to ask questions throughout the sessions via the chat function. We will make sure that the questions reach all of the speakers and come back to you as quickly as we can. You can also put any questions on the feedback link that will follow post-event. The team will send you out your CPD certificate and a copy of the slides via email, so please rest assured that these will land in your inbox very soon. As you might expect, there is a little housekeeping. We'd simply like you to relax and enjoy the session, but do note, in order to receive your CPD certificates, we do need to see that you've watched the entire session. If you have any technical issues, please do drop a comment in the comment section and one of the team will assist you. So hopefully you're settled now and ready to enjoy the first speaker in our lineup. All that remains is for me to introduce him. So our first speaker is Duncan McInnes, Investment Director at Ruffer. He's going to share some valuable insights on preserving capital through turbulent markets and periods of regime change, because investors are really having a tough year, caught between the rock of higher inflation and the hard place of recessionary worries. Asset prices have bled lower. A combination of COVID-induced supply chain disruptions, a shifting labour market, and geopolitical events have left an already fragile financial system reeling. Here with some valuable insights and kicking off this multi-asset webinar, Duncan McInnes, Investment Director at Ruffer.
Hi everyone, I am Duncan McInnes from Ruffer, and this is Crossing the Rubicon, Capital Preservation and Growth in the New World Disorder. So first, a little bit about Ruffer. We are a 26 billion under management asset management firm, and we only do one thing. That is a global multi-asset, go anywhere, absolute return strategy. And we've been doing that since 1995, and over that time we've delivered just under 9% per annum after fees to our investors. But importantly, we've done that with a low correlation to global equities or to any other asset class or strategy that you might want to compare us to. Importantly, the business is a partnership, and that means that we have aligned interests with our clients and investors for the long term. How have we performed? Well, we're known reputationally as bear market operators, and that's because we have performed well in each of the three major crises since the firm began. We made money in the dot-com bubble. We were up 20% when the market was down 30% in the financial crisis. And in the COVID crash, we preserved capital when markets were down 25% and then made money in the balance of the year. And perhaps we're in the fourth crisis in our firm's history today. And we'll see how the performance turns out over time. But over the fullness of our history, we've outperformed equities, and we've done that with less risk, with less volatility and greater multi-asset diversification. But what we're most proud of is the risk management across all of these different market and economic environments. During the time the firm's been around, the FTSE has halved in value twice and fallen by 20% two more times. Ruffer's peak to trough loss is less than 10%. So let's update on what's been a pretty remarkable year so far in 2022. Just looking at September alone, we had the winning of Liz Truss winning the Tory leadership campaign. We had some energy bailouts. We had rate hikes from the Bank of England, which weren't quite as much as people expected. We had the beginning of quantitative tightening. And of course, we had a gilt and pension market crisis. Then a return to QE, and then all the tax cuts that were announced were cancelled. And it's not surprising, perhaps, that the volatility in the gilt market was truly unprecedented, as you can see on the slide here. In 1 week alone, the long-dated inflation-linked bonds were down 27% on the Monday, 24% on the Tuesday, 20% on the Wednesday morning before the Bank of England intervened. They then rallied 115% in the afternoon, 16% on the Thursday, and 30% on the Friday. Truly unprecedented and a remarkable thing to see in a developed market, a developed world bond market. But it's not just the UK. Bonds globally have had a record bad year. So much for a safe haven. It's been one of the worst times for fixed income investors that we've ever seen. But it's not just been fixed income investors either. There really has been nowhere to hide this year. We've seen a failure of diversification, highs in cross-asset correlations, everything moving in the same direction. And unfortunately, that direction has been down. If you were smart enough in Q1, you could have been in commodities and while stocks and bonds fell, they rallied. But in Q2 and Q3, everything fell. Stocks, bonds, commodities, private equity, property, venture capital. It really has been remarkably difficult. And so it's pleasing for us that in that context, we have managed to deliver a positive return for our shareholders. And how have we done that at a time when conventional assets have struggled? Well, we've done it by relying upon our unconventional assets. This is really a differentiator of the Ruffer strategy versus many peers, and it's been the saving bacon, or saved our bacon in the last couple of years. First in 2020, it was things like equity puts, it was protections against corporate bonds. Later in 2020, we invested in Bitcoin, which was quite high profile at the time. And this year, it's been interest rate options that rise in value when bond yields rise, and has acted as a much needed hedge in our portfolio and has delivered that performance over on the left hand side there. Right, so moving on to the market outlook. We've been talking for a couple of years about the world moving into a new regime, and I think it's quite important to recap what the old regime looked like before we talk about the new one. And it existed for 40 years between 1980 and 2020, and really it was characterized as the Great Moderation, and it was involved falling rates and falling inflation, as shown on the chart, driven by cheap energy, cheap goods, and cheap labor. Cheap energy from people who are now characterized as the bad guys, Russia and OPEC. Cheap goods from China as a derivative of globalization, and cheap labor as labor was outsourced to the emerging world, but also held below its perhaps fair price in the West by the forces of globalization, as mentioned. And we think all of these are going into reverse. Inflation and interest rates are going up from 5,000-year lows. Globalization is becoming deglobalization. Now, this is a trend that was already in motion pre-COVID because of Cold War II between China and the US, but it was very much accelerated by the supply disruptions that we saw in COVID, businesses moving towards reshoring their manufacturing, and then of course has been accelerated by the troubles in Ukraine, which has only gone to exacerbate this idea of a bipolar world. The political environment too has changed from capital favorable under Thatcher, Reagan, Blair, Clinton, etc., to an environment now where tax the rich, break up big tech, and windfall taxes are the order of the day. So altogether, a far less favorable environment for capital. So what does the new regime look like? Well, we think it's a return to inflation and inflation volatility, importantly, like we saw in the 1940s, the shaded area on this slide, or indeed in the 1970s. And through this prism, actually, the period from 1980 to 2020 looks like the aberration. It really does seem quite benign. We think we'll see a world of financial repression. That is where interest rates are held below the rate of inflation, forcing negative after inflation returns onto savers and investors. Now, what drives the volatility of an inflation volatility regime? It's that every time there is weakness, it will be met with fiscal and monetary policy stimulus. And I think these will be under three big banners. The first one, climate change and the energy transition. The second one, tackling inequality in all of its different guises. And the third one, taming the geopolitical ambitions of China and Russia. So think things like reshoring and energy independence or defense spending. Now, we think it's pretty clear that this new regime has arrived, and increasingly we're getting less pushback from investors who are seeing it in front of them. But one set of people who doesn't believe in the new regime, perhaps unsurprisingly, is the Bank of England. Now, this chart shows realised inflation in the green line, and the dotted lines are where the Bank of England thought inflation was going to go at various different points of time. So if you'd asked them a year ago where inflation would be today, they would have said 3%. Of course, the actual answer is 9%. Now, despite these pretty large, that's putting it favourably, errors, they still remain highly confident that inflation is going to gravitate down towards 2% in the coming years. Now, it's easy to poke fun at the Bank of England after their recent troubles, but what really matters is what's priced into markets. Inflation is front page news. It demands discussion and leads the investment debate at the moment, but remarkably, it is not priced in. This is the five-year forward inflation expectations, which tells you what the market thinks inflation will be from 2027 out to 2032. And despite having recovered from the deflationary abyss of COVID, you can see those inflation expectations are bang in line with the long-term average. Certainly not, I think, what people would expect given our recent lived experiences with realised inflation. And this is not us cherry picking. One example, you can look at oil futures where spot oil might be $90, but a year or two out, it looks like $70. You can look at other commodity curves saying the same thing. You can look at the price to earnings multiple of inflation beneficiary sectors in the stock market, very low, suggesting that the inflation is not here to stay. Now, this is the opportunity. If we are right about this new regime, then there's a lot of money to be made as the world starts to price it in. Now, if we go on to the other side of that debate, I think another sign that we're early in this great rotation towards inflation assets is what I've got here. This is ARK, the profitless tech darling fund of the post-COVID era. The blue is the price of the ARK fund, and the green is the shares outstanding. Now, what this shows you is that we have yet to see any capitulation. One thing that we normally see in bear markets is equity outflows and people giving up on the darlings of the last cycle. What this chart shows is that ARK has experienced no net redemptions. Investors have yet to give up on these profitless tech, wonderful companies of the future that they were so wedded to in the post-COVID period. And this says to me that the market thinks that old regime of low and steady inflation, low interest rates, high valuations, and a very high price on potential profits in the future is going to come back. And we couldn't disagree more. Because to be bullish on the equity market today, you have to believe 4 pretty challenging things simultaneously. Here we have first that the Fed will raise interest rates to above 4%, but certainly not much further than that. That 4% interest rate, which they'll reach early in 2023, will slow the economy, but not too much. That slowing of the economy will lead to either a very mild recession or even better, a soft landing, as they call it, which will suck all of the inflationary pressures out of the system. And all of that can happen without any pressure on corporate profit margins or upsetting the fact that the stock market is currently pricing in 8% earnings growth next year. And I probably don't need to tell you that earnings tend not to grow in recessions. Now, all of this is possible, but to us, it's not likely. If you think each of these different events is, say, an 80% probability, which I think is a little bit optimistic, then the cumulative probability of all 4 happening is just 1 in 3. So we're in a very difficult spot here. The Fed and global central banks need to raise interest rates to slow down nominal economic growth and to cool the inflationary pressures in the system. And yet, as this chart demonstrates, they are miles behind the curve on this. So this chart is the Fed funds rate in green and wage growth in blue. And what it shows is that in every economic cycle, the Fed need to get interest rates above wage growth to take that inflationary impetus out of the system. And today, that would mean a Fed funds rate up in the 6, 7, or 8% range. Now, I can assure you that that seems unlikely to happen from the current starting point because of this. When that happens, something always breaks. Every Fed hiking cycle in history has ended in a market crash, a recession, or both. This is the US 10-year bond yield in a 40-year descending channel. This is that great moderation that I showed earlier. And every single time bond yields or interest rates get up towards the top of this channel, something bad happens. Now, I think the reason the channel is descending is because of ever increasing leverage and financialization in the system. But this whole situation reminds me of dynamite fishing. Now, you might have to go on YouTube to see what dynamite fishing is. It's not particularly ESG friendly, I warn you, but you throw a stick of dynamite into the water, it explodes under the water, you feel the boat rock from that unleash of force, and then there is a dead calm. And then, slowly, dead bodies start to float to the surface. And I think we are in that interregnum period of dead calm right now. We've seen some dead bodies float to the surface in the crypto sphere. Perhaps the LDI pension and gilt crisis in the last few weeks is one of the biggest dead bodies, but I think it's highly unlikely with how fast rates have moved up, how much leverage there was in the system, and how quickly the economic outlook is deteriorating, that there aren't going to be more dead bodies in the near future. So how do we invest around all of this? Well, we've been in an environment for the last decade or so where TINA was the dominant mantra. TINA, which was borrowed from Margaret Thatcher, stood for there is no alternative. And today, I would say that TINA is out the window and has been replaced by TINA. There is now alternatives, because the biggest change in the last decade is that when investors had zero interest rates on cash, they were forced to speculate. They moved out the risk curve into sovereign bonds, investment grade, high yield, and eventually equities when seeking that return that they needed. Today, a 2-year, 5-year, or 10-year bond in the UK or US pays 4%. By the end of the year, you can get 4% on cash deposits. That is a very high hurdle for risk assets to beat, and it makes us incredibly conservative. So we have our portfolio positioned with a lot of dry powder to take advantage of what we think will be a significant amount of de-risking as the economy deteriorates and as investors de-risk their portfolios from risky assets towards riskless assets that now all of a sudden pay attractive yields. Now, the opportunity there is that if you are the only person that shows up to an auction, then it's pretty likely that you're going to get a good price. Plus, we have these forced selling dynamics that we're starting to see from pension funds and other investors, people who have to de-risk, sell what they can rather than what they want to, and we want to be on the other side of that. And as a firm, we have a history of doing exactly that. So this is our portfolio today, as I said, particularly defensive and significantly buttressed by protections to look after equity market downside, but we are really optimistic about the potential for us to be able to buy into future expected returns that are starting to look better in distressed markets. Thank you for your time.
Thank you, Duncan. Duncan McInnes, Investment Director at Ruffer. Now, our next speaker is Tom Buffum, Portfolio Analyst at RBC Brewin Dolphin. He is tackling the differences between ESG, sustainability, and responsible investing. Tom's going to dive into what advisors could consider when selecting a sustainable portfolio or fund, and outline what the expected performance differences are between sustainable and more traditional portfolios. He'll explain how you can translate ESG metrics to clients and what role they play in your process before dipping into what ESG regulations advisors should be focused on. I'm pleased to welcome next to your screens Tom Buffum, Portfolio Analyst at RBC Brewin Dolphin.
Good morning, welcome, and thank you for joining me on this RBC Brewin Dolphin session on ESG, sustainable and responsible investing, trying to understand the difference between those. On this first slide, I have put down the responsible investment spectrum, and this is a stylized version of what the CFA Institute believe is the spectrum of responsible investment. And you can see it goes all the way from ESG integration all the way to the right of impact only. Now, I just want to quickly touch on the difference between some of the terminology here. So responsible investment refers to any investment that goes from that far left of ESG integration at the bare minimum, all the way to the far right, which is impact only, effectively philanthropy with no expectation of a financial return. Now, I've mentioned another one of the acronyms there, ESG. They are risk factors rather than a style of investment. So they are environmental, social, and governance risks. And the reason they're picked out is because traditionally they were not part of financial analysis when assessing companies for investment. And the reason behind that is they're quite hard to quantify. So an environmental risk such as an oil spill or a future carbon tax coming in, they're quite unlikely events. They don't happen every year. They maybe happen every 10 years. But they are potentially financially material, but because the probability is so low, it's very hard to assess that. And so traditionally, they weren't taken into account. What we're seeing now with the adoption of the UNPRI more widely is that most investment processes are now integrating these risks and finding ways to quantify these factors. Interestingly, and perhaps surprisingly, social risk factors often come up as the most financially relevant if you read the academic research papers. Now, sustainable investment is the other key question here. So what is sustainable investment? And you can see it's kind of halfway along that spectrum. Now, sustainable investment is investing in companies that have sustainable business practices. So they look to avoid either overexploitation of a resource. So for example, chopping down rainforest or overfishing from a sea in a way that that finite resource will eventually be depleted and the business model will actually collapse. Or also over polluting and producing waste that will actually eventually lead to destruction of the wider environment. The other thing I wanted to touch on is what we do within our Brewin Dolphin portfolios. So our active MPS, we consider as a responsible investment choice. And that is because it integrates ESG into the research process. So when we assess fund managers, we look at their credentials from the ESG integration angle. And we also apply stewardship in terms of controversy tracking across all of the fund managers that we're invested with. Our sustainable portfolios go further along that spectrum. So they compose of the negative screening, which ethical investors find very important, and they exclude areas where we don't believe that we could impact or influence material change through engagement in that area. Areas like tobacco, because a tobacco company is never going to become a force for social good, no matter how much you engage with the CEO or the CFO. Also, all of the investments look at a minimum to invest within sustainable companies as their universe. But beyond that, we think there are opportunities thrown up by the global energy transition that we're undergoing as part of net zero. And so we think there are new industries that are forming today, things like green hydrogen, which are going to power planes from 2030 onwards that almost don't exist today, but in a couple of decades' time will be multi-billion-dollar industries. And so we have a couple of funds that look to take advantage of these new areas and trying to find attractive opportunities there to help drive client returns as well. Now, another question I get asked a lot is, what should advisors consider when selecting a sustainable portfolio or fund? And it's a really good question because there's a lot of stuff out there and it's really hard to understand which clients should go into which products and why you should choose one product over another. Now, I've boiled it down to 3 key points. Firstly, I think it's really important to make sure any investment product is well aligned with your client's values. Now, this is a really challenging conversation to have as an advisor, because often a client doesn't really understand what is possible to do within the investment universe, or what the impact of potentially divesting or an engagement product are versus each other. And so there's often education that comes alongside that conversation. The obvious solution is to understand the client's ethical preferences and screen around that. But as we'll get into later, at Brewin Dolphin, we believe engagement is actually an even more powerful driver of change than divestment is. Another key point, I think, is it's important to use investment products with really good transparency and clear reporting, so that when a client meets you for an update on their portfolio, not only will they get the standard investment update, but they'll also be able to see what's going on within the portfolio from a non-investment perspective. So things like what engagement and stewardship's happening, how well the portfolio stacks up from an ESG perspective. And so I think it's important that you make sure you partner with providers that do provide that extra collateral. And it's also important to make sure that any assessments and ratings are independent and they're not internally generated, because we do find that some providers mark their own homework, and of course they get very high ratings, but they're meaningless when they're generated internally rather than provided by an independent third party. And finally, we think investment stewardship is key. And this is because we believe that engagement is what is driving change for the better at the company level rather than a divestment. Now, the research shows that divestment can work, but only when there is mass market adoption. The key example being Russian sanctions, where Western governments outlawed quite a large swath of investments and trading of those investments in Russia. And of course, what you see is the cost of capital for those businesses move up very quickly, and it's really hurting the Russian economy, which is the desired effect. However, in areas where there isn't such mass market adoption, that's where you'll find that divestment doesn't have the impact. And actually, all that happens is those shareholders who want to divest just don't hold those stocks, and someone else will provide capital to that business. It really needs a broad range of investors to exclude a stock for it to be meaningful and to have a real financial impact. And the other area of investment stewardship that's important is to make sure you really understand what's going on inside the provider. And an external accreditation that we think is very valuable is the UK Stewardship Code, because unlike the UNPRI, which has a relatively low bar to enter, the UK Stewardship Code is very stringent, and each year the criteria keep getting harder. So any fund houses that do manage to sign up to that have to keep improving their processes. And it is a real mark of quality in terms of investment stewardship. Now, performance is always a key question. And what we've seen over the last decade or so is very strong performance from sustainable portfolios. In fact, they've typically outperformed the broader market. Now, that, as it happens, has been due to luck rather than any structural tailwind for this part of the market. And the reason is that sustainable portfolios are typically overweight growthy companies and mid-cap companies. Now, these type of companies do very well in a low inflation, low interest rate world. And that is what we've seen up until probably about a year ago. And at the beginning of 2022, we saw inflation pick up and we saw interest rates pick up. And you can see on the chart on the right that the SRI index in red has underperformed the MSCI All Countries World in blue, even though it had very good long-term outperformance of almost 2% a year prior to that. And the reason is, again, it's not because sustainable investment has suddenly stopped working. It's because the market environment has changed such that growthy companies are likely to underperform in this environment. So I think the key takeaway here is that there will be a performance differential between a sustainable investment and a traditional investment. Now, there's research that says sustainable portfolios should outperform. There's research that says sustainable portfolios should underperform. The jury is still out, and the truth is we don't have enough data. We only have about 20 years of data, and that isn't enough on the kind of time to get a statistically significant sample. So it's important that clients understand that there will be a performance differential. It could work in their favor, it could work against them, but the key thing is that they are in the portfolio for the right reasons, which isn't for chasing performance, but because it agrees with their ethical code, their moral stance, and it's where they want their investments to be directed. So in related to earlier, I talked about how it's important to have clear reporting and transparency. So I wanted to shine a light on some of the things we do in terms of helping advisors talk to their clients about what's going on in our sustainable range. So we've chosen MSCI as a partner, and they rate our different products with an MSCI ESG rating, as you can see on the left there. Now we put these on both of our active MPS and our sustainable range. We also try and show transparency in our portfolios around the carbon intensity. So you can see that we will have the carbon intensity of our sustainable range versus the carbon intensity of the benchmark. Now, the reason we only report carbon intensity and we do not equate this to other real world emissions such as cars taken off the road or fewer miles driven is because carbon intensity on a portfolio is not the same as emissions avoided in the real world. And while clients would like to think they're the same, we think it's greenwashing to effectively call those two things equivalent. And let me give you a quick example of that. So if I was to walk to the station instead of drive my car to the station, I will obviously have saved burning the little bit of petrol in my car, and therefore I will have avoided some real world emissions by making that decision. Or it's the same with the thermostat. So at the moment we're going through an energy crunch, and a lot of people, either because they're conscious of energy bills or want to do their little bit to help the country deal with the gas shortages, are lowering the thermostat, and therefore their gas boilers are burning less natural gas and emitting less carbon dioxide into the atmosphere. And that is a real world saving. However, if my portfolio was 100% invested in a really emitting company, maybe Exxon or Chevron in the US, big oil companies, so they emit a lot of carbon dioxide per $1 million of revenue. And let's say I sold my shares in those companies, and instead I bought some renewable providers, maybe Ørsted, who build offshore wind turbines. Now, obviously, that has really lowered the carbon intensity of my hypothetical portfolio because Ørsted has a much lower tons of carbon dioxide emitted per $1 million of revenue than Exxon and Chevron. However, by moving my investments, I haven't actually stopped Exxon or Chevron doing any of their activities. I haven't stopped them drilling new wells. I haven't stopped them exploring for new deposits, and I haven't helped Ørsted put up a new wind turbine. So it's a false equivalence of lowering your carbon intensity than it is actually avoiding a real world emission. So that's why you'll only see carbon intensity on our functions. And then finally, to give clients a high level view on the impactful companies and the positive influence that their portfolios can have on the world, we've used MSCI's SDG alignment measure. So MSCI assess every single company in the universe, well, almost every company in the universe, against the 17 SDGs and assess whether they're aligned or unaligned. So we report this on our sustainable fact sheets, and so it gives clients that real look through and gives them a sense of the positive impact from the portfolios. Finally, I wanted to talk about the difference between divestment and engagement. And so I mentioned earlier how divestment only works when it has a mass market adoption. So the real question is, what do we do around engagement and trying to make sure that our portfolios are really having a change on the world? And this is quite important for us because we don't just apply this to our sustainable portfolios. This we apply for our all of our active portfolios across the full piece, which is why our active MPS is also a responsible investment product. So every 2 weeks, we load all of the holdings in our portfolios into two tools, Sustainalytics and Moody's ESG, which used to be called Viego Iris. Now, these tools scan the news wires and capture any lawsuits, any controversies, and we look to see which ones have popped up within our underlying holdings within our fund managers. We also scan some news sources ourselves. So for example, we're reading the Bloomberg news wires. We're also looking at the FT as well, and trying to capture anything that we think would be really relevant to clients. Now, for those issues that are material for the business, relevant to clients, or particularly widely held across our portfolios, we will reach out to the fund manager and engage with them. Now, every single one of our fund managers across both of our sustainable range and our active MPS are UN PRI signups. Now, that means they have ESG integration as part of their processes. So we are expecting a response and for them to understand the various issues going on at the companies they're invested with. So once we collect the responses, we assess them, we can compare them against each other, and we can do a bit of a post-mortem on them. And there are examples where fund managers have been a bit disappointing in their responses and they haven't reacted appropriately in our view. In those cases, we can escalate within that fund management company and either observe that they're not doing what they said they would do, or effectively ask them to raise their game. And in the past, we've done this through talking to their central sustainability team and highlighting the difference between their marketing material and what they say they do versus what the fund manager is really doing in real life. Thank you very much for your time today. I really appreciate it. I hope that was interesting. Feel free to reach out if you have any further questions.
Thank you, Tom. Up next, we have Hugo Thomson, investment specialist at HSBC. Over the past 10 years, the UK market has been a perennial underperformer. At the start of 2022, it was one of the few equity markets to deliver positive returns. So what does the future look like for the UK? And should your UK-based clients have a UK bias within their portfolios? Get ready for Hugo Thomson, multi-asset investment specialist, as he examines the reason investors hold UK biases within multi-asset portfolios and dissects the rationale behind each. Not is all as it seems. Investors might be better off holding a more diversified exposure, as old adages don't always hold true. Ready to bust 5 myths? Ladies and gentlemen, Hugo Thomson.
Hello there. So the session that I'm going to be delivering today is about global versus UK investing. And the reason that I wanted to talk on this topic today or during this session is because there is a tendency for investors to have home biases within their portfolios, be it a UK investor having a UK bias or any other regional investor having a regional bias. Now, what we wanted to do during the call today is cover three key learning objectives. The first of which is understanding why is it that investors want these biases in their portfolios. The second is recognizing, well, what exactly are the differences between the UK market and a global market, and therefore understanding the consequences of introducing these biases. And finally, at the end of the session, if we have come to the conclusion that actually having a UK bias in a portfolio isn't the best idea, considering some alternative ways of constructing the asset allocation, the geographic asset allocation of a solution. So without further ado, let's start by looking at those common reasons that investors have UK biases in their portfolios. Now, reason number one, without a doubt, the idea that we hear most commonly cited as the reason investors will have UK biases within UK portfolios is because the UK market has outperformed a globally diversified portfolio. Now, every one of the reasons, or as we refer to them here, myths around UK biases in UK investor portfolios, within each of the myths, there is a grain of truth. Now, the grain of truth in this particular myth is that you can find certain periods during which a UK biased portfolio outperforms a globally diversified one. And interestingly enough, one of those periods is year to date. At the very beginning of 2022, the sort of first 8 months of the year, really, we saw a UK biased portfolio outperform a globally diversified one. And the reason for that, you can see on screen, is the strong outperformance of UK equities versus global equities. Not only has the UK market, or did the UK market deliver positive returns in the face of negative returns from global equities, it was one of the very few asset classes, full stop, that was able to deliver positive returns. Now, as impressive as this may be, it is admittedly a relatively short period of time. So what were to happen if, instead of looking at this relatively short period of time, we were to look at a longer period, say 20 years of data? And that's exactly what we have done. We constructed a 60-40 portfolio using 20 years of Bloomberg data, and we constructed one of these portfolios using global bonds and global equities, and one of the portfolios using UK bonds and UK equities. Now, I'm going to have to trust that no one cheats here, but I will ask you, just in your mind, to imagine how many of the past 20 years do you suppose that UK portfolio outperformed a globally diversified portfolio? You can pause the video if you want to have some more time to think about it, but I can now reveal that the answer is only 4. 4 out of the past 20 years saw that UK portfolio outperform a globally diversified one. 4 out of 20 years is about 20% of the time. What do we take from a piece of data like this? Obviously, we don't want to overreact to it. Does it mean that the UK is a terrible market, a market that can never outperform or hardly ever outperform a global portfolio? Should we remove the UK from our investor portfolios? All interesting questions. I would suggest no. We don't want to purge UK portfolios of UK exposure. The fact of the matter is, we wouldn't expect any given regional market to consistently outperform a globally diversified portfolio. In fact, 4 out of the past 20 years sounds about right for how often we see outperformance. And you can probably see that point best illustrated on the next slide. This is my quilt chart. And what we show on the quilt chart is for the past 10 years, the calendar year performance of each of the major regional equity markets. And then we rank order that performance in any given year from highest to lowest. Now, make no mistake, during any given year, the best performing market is by definition going to outperform a globally diversified solution. That is in fact a matter of mathematical certainty. However, the other thing that you can see from this chart is that whilst one given market might outperform or be the best performing market in any given year, it's very unlikely for that same market to be the best performing market the next year, or indeed to be the best performing market the year after that. So whilst you can find a regional market that delivers outperformance during a discrete period, over the long term, a globally diversified solution with access to all of that growth, regardless of where it comes from, is going to deliver the best returns. And you can see that by looking at cumulative rather than discrete performance data. Here, the black bar represents that global 60-40 that I was talking about a couple of moments ago, and the red bar represents a UK 60-40. And what you can see is that year to date, that black bar has delivered -7%, whereas the red bar has delivered only -5%. So you see that outperformance we were talking about of a UK portfolio. However, if we look at 3 years, things really start to reverse. A global portfolio has outperformed, a UK portfolio has barely delivered any returns at all. You see a very similar thing over 5 years, you see exactly the same thing over 10 years, and you in fact even see the same thing over 20 years. 20 years of performance is so strong it goes off the top of the chart there. So hopefully we have put to bed the idea that you want a UK bias in UK investor portfolios because of the performance that it delivers. But of course, performance isn't the only reason that an investor might want to introduce a UK bias into their portfolios. Other commonly cited reasons for biases such as these are that the UK market is cheap, and because it is cheap, that makes it attractive. Now, I wouldn't disagree with the first part of this statement. The UK market sure is cheap. If you look at the price earnings ratio of the UK versus global equities, you can see that the UK market has a lower price earnings ratio than a global market. And this is by no means something that is a kind of flash in the pan, if you like. You actually see this relatively consistently. If you look over history and you track price earnings ratio of global equities in black there versus UK equities in red, you can see that outside of a few periods of market turmoil, the UK consistently trades at a price earnings discount to global equities. In fact, you have to go all the way back to the very beginning of this period in order to see the UK be not trading at a price earnings ratio discount to global equities. There are a couple of years here at the beginning in the early 1970s where the UK and global equities trade on par with one another. All of that having been said, the key point is that over this period, 50 years of data, which is about as long as we have data for, the average price earnings ratio discount of UK versus global equities is 25%. So does the fact that the UK market is trading at a discount to global markets make it attractive? Well, it makes it cheap, but I would argue it doesn't make it attractive, and that's because the UK market always looks cheap. The discount we see today isn't the investment opportunity of a lifetime. It shouldn't be used to justify these large UK overweights because it is just a structural feature of UK equities that means they are unable to command the same price earnings ratios as their developed market counterparts. Myth number 3 is that stock pickers have a home team advantage. Now, this is not just a myth that you hear in the UK market. It's something that you hear across the world. European portfolio managers with European biases say that they know the European market better than any overseas investor possibly could, and therefore they have an advantage when selecting securities there. You'll hear the same thing from Asian investors. You'll hear the same thing from UK investors. This myth is in fact so widespread that Morningstar, the global funds database, did some research that sheds light on it. Morningstar was looking at European portfolio managers, and they were trying to understand when a European portfolio manager was investing in overseas equities, how successful they were. So they looked at the 10-year success rate of active managers, and what you see on screen is the proportion of those active managers over a 10-year period that managed to outperform their respective regional equity benchmark. Now, what you can see from this data is that far from there being a home team advantage, there seems to be an away team advantage. The further away the portfolio manager is from the market in which they're investing, the more likely they are to outperform. Now, again, can we actually conclude that there is an away team advantage? Probably not. There's certainly not enough data here to conclude that. But what we can say is that there are myriad factors that determine how difficult or easy it is to outperform a given regional market. And therefore, those factors are going to by far overwhelm any perceived or real informational advantage. So portfolio managers that are justifying their home bias with home team advantage are either woefully misinformed or willfully misleading. Myth number 4. The UK's exposure to the value factor will be beneficial in the near future. Now, in order to understand this myth, you have to understand why it is that investors like the value factor. And the reason is relatively simple. The received wisdom tells us that a value company is going to outperform the market during periods of rising interest rates. The problem, of course, is that HSBC is a little bit skeptical of received wisdom. So we did some of our own research into this myth, and we found something quite interesting. We found that whilst there are periods where where interest rates are rising and value companies outperform, it by no means always happens. In fact, there are 2 macroeconomic factors that need to be in place in order for value equities to outperform. Firstly, you need rising interest rates, and secondly, you need accelerating economic growth. In this market environment, a value company is likely to outperform. The problem, of course, is that this is not the market environment in which we currently find ourselves. Although interest rates are rising, in our view, economic growth is actually decelerating. So last year, global GDP growth was about, last year, 2021, in 2021, global GDP growth was about 6%, just under. And we think in 2022, global GDP growth is going to be much lower than that, maybe 2.5%, 2% for the full year. So still positive, yes, but decelerating. Now, in a market environment where interest rates are rising, but growth is decelerating, it's quite a difficult market environment. And the problem with value companies is they don't perform very well in difficult market environments. In our view, the better companies to be holding in a difficult market environment are quality companies. A quality company, often described as a fortress company. These are companies with moats around them, famously. Moats, things like pricing power, very, very strong earnings. And the reason that these companies perform well in difficult market environments is if, for example, we take inflation, which is a very big topic at the moment. In an inflationary market environment, because of the pricing power that quality companies have, they are able to take the increases in input costs that they experience and pass those increases on to consumers in the form of higher prices, and in doing so, protect their profit margins for investors. The problem, of course, with the UK market is that it has very little exposure to quality. Whilst it's high value, and if you think value is going to perform well, then the UK perhaps will be the place to invest your assets. Over the next 6, 12, 18 months, and even over the long term, the lack of exposure to anything high quality, we think, is potentially a problem for the UK. Myth number 5, the final myth, the final reason we see investors citing for having UK biases in UK client portfolios is that it reduces portfolio risk. And the thinking here really goes that when you invest in a global portfolio, you are taking global currency exposure. And by introducing a UK tilt into that portfolio, you are reducing the currency exposure of the portfolio. If we break this idea down a little bit further, if you are a UK investor holding a UK portfolio, then your portfolio is going to have a single return driver, and that is the performance of the underlying securities within your portfolio. On the other hand, if you are a UK investor buying a global portfolio, your portfolio is going to have two return drivers. The first being the performance of the underlying securities that you hold, and the second being the performance of the currencies that you are holding. Now, the question, of course, is, does introducing this second return driver, the currency return driver, increase portfolio risk? Now, the answer to this is it depends. And what it depends on is how you define portfolio risk. When most portfolio managers talk about risk, they're probably talking about the standard deviation of returns or the volatility of returns. If you look at the historic data, interestingly enough, a portfolio that has global currency exposure has actually delivered a lower level of volatility than a carbon copy of that portfolio with the currency exposure removed. Other metrics of risk, of course, that we can use are things like maximum drawdown. Here again, you get lower maximum drawdown when you introduce that currency exposure. You get better Sharpe ratios with portfolios that have currency exposure. You get reduced value at risk, and you get an improved CVAR. Now, I can talk for a very long time about the importance of minimizing portfolio CVAR. The problem is most end clients probably aren't going to know a great deal about CVAR, what it means, what its implications are. And this really taps into one of the core inconsistencies or tensions in our industry. And that is the tension between what portfolio managers think of as risk, which are basically described on this slide. You could perhaps introduce some additional metrics, but this is the sort of thing a portfolio manager thinks about when they talk about risk. And what our clients think about when they refer to risk. I would bet that the majority of your clients, when they ask you how risky is this portfolio, what they really mean is how likely am I to lose money if markets start to fall. Now, here again, if we look at the historical data, comparing in black a portfolio, a 60-40 portfolio that has no currency, that has currency exposure, and then in red, the portfolio that doesn't have currency exposure, what you see is that during some of the most significant market drawdowns of past history, it is the portfolio that has that currency exposure that experiences the lowest level of market falls, or that loses the least amount of money during periods when markets are falling. So far from reducing portfolio risk by adding in a UK bias, you're actually increasing portfolio risk because you are reducing one of these defensive return drivers, which is currency exposure. So if I have managed to convince you that indeed it doesn't make sense to have a UK bias in portfolios, the next question is, well, how do you allocate the geographic exposure of a solution? One option would be to have an equally weighted portfolio. You have the same level of exposure to every single country. This means that regardless of which country is delivering the best returns, you're going to have an equal level of exposure to it. And it also means you're probably going to maximize the diversification benefit of your portfolio. The difficulty, of course, with a solution that looks like this is that it has the same allocation to China as well as Indonesia. It has the same allocation to Germany as it does Greece. And we as investment professionals just intuitively feel like that's probably not the best idea. We recognize that different countries have different levels of importance to the global economy. And we want to reflect that within our portfolios. Ultimately, what a portfolio is trying to do is capture economic output. And you can actually see the contribution to global GDP, to global economic output of different countries on this slide. And this slide probably speaks to why HSBC constructs its portfolios in the way that it does, and that's through a market capitalization weighting scheme. A market capitalization weighting scheme weights the regions in the portfolio according to their importance to global capital markets. So you get that global exposure, but you also recognize that not all countries are equal. So that's probably more than enough from me. During this session, the key things we've learned are those 5 common arguments for UK biases in portfolios. Secondly, the differences between UK and global markets. And thirdly, we've explored some other ways of allocating portfolios. If I might very briefly have 5 minutes of your time to discuss HSBC. I work within the multi-asset team at HSBC, and we really have 4 key solutions in the intermediary market. The one that I imagine most of you have heard of is the global strategy portfolios. This is our flagship offering in the market. It is a range of 5 risk-rated, globally diversified solutions. It is our kind of simplified, cost-efficient portfolio that is designed to sit at the heart of an investor's investment process. Global strategy has been very successful over the past kind of 5 years. We've raised about 6 billion sterling into it, so it's a very, very good product. If you like global strategy, if you use global strategy, then you're going to love our managed portfolio service. It follows exactly the same investment philosophy as global strategy. However, it's got a few more bells and whistles designed for those more sophisticated investors, those more interested investors who want additional levels of client servicing, who want to understand their portfolio with a little bit more detail. A managed portfolio service is for them. Of course, we have a sustainable set of portfolios. Everyone's doing sustainable these days, but we think we do ours a little bit better. We've certainly been doing it a bit longer than most people. We're coming up to our 4 years of track record in these solutions now. And finally, we have the world selection portfolios. This is really the big daddy of HSBC's multi-asset capability. They are our largest portfolios, 15 billion sterling in these solutions in the UK alone. We also have these solutions sold globally, where we've probably got that amount of AUM in them again. So in total, a very big solution. This is our most comprehensively diversified solution for those investors who want to pay a little bit more to get a little bit more. The world selection portfolios have been performing particularly well this year, helping smooth that market volatility that we've seen. Speaking of performance, I really do think that the performance track record of these solutions is the jewel in the crown of the multi-asset range. Across all of these portfolios, we are delivering top quartile performance. That's compared to the Morningstar peer groups. You could also compare us to the IA peer groups. You'd see a similar thing. Top quartile performance across the board. Top decile performance. 90% of the portfolio managers that are trying to do this will underperform the HSBC solutions over the longer term time horizons. And that's not just for total returns, it's also for risk-adjusted returns. So every unit of risk we put into the market, we're getting more return than our peers do. As I say, if you'd like to hear any more about any of these solutions, please do reach out to your local HSBC BDM. And other than that, thank you very much for listening.
Hugo, thank you. Now, I'm sure that this pair really need no introduction. Dream team, Paul Henderson, Managing Director of BlackRock, and Lloyd Walton-Rees, Vice President of BlackRock, deliver a masterclass in diversification. This year, more than ever, diversification in portfolios is key to ensure the best for investor outcomes. In this discussion, they will review the current macro environment and the need for diversification across equities, bonds, and commodities within multi-asset portfolios. They'll also focus on the benefit of using indexing and, more specifically, ETFs within MA portfolios to achieve a flexible portfolio designed to maneuver through these volatile times. The stage is now set for Paul Henderson and Lloyd Walton-Rees, Managing Director and Vice President of BlackRock.
Hello, my name is Paul Henderson, and I am a member of the BlackRock Investment Institute. The Institute builds BlackRock's macroeconomic narrative and medium to long-term investment views. And today I'll be giving you a brief overview of our broad global macro framing, some specificities on the UK, and an insight into our investment views before I hand over to one of my colleagues, Lloyd, to describe some of the implementation vehicles that can be used to deliver on portfolio objectives. But first, I'd like to start with a foundation of our view that the long period of steady growth and inflation known as the Great Moderation is over. So the first chart on the slide here shows the volatility of two macro variables, that is inflation and growth in the US, and shows us that the low macro vol environment to which we've all become accustomed has of course not always been the case before the 80s. It's certainly not the case now, and in our view will not be the normal going forward. But what caused this period of low volatility? Well, in very general terms, this was a period of low and steadily expanding supply side. So we had globalization, we had the emergence of China, and all of the shocks in this period were demand driven. And in this environment, the tools of a central banker, so the policy rate, was an effective tool to control that demand. So the result was rate hikes to curtail overheating, rate cuts to stimulate the economy, and that resulted in a relatively stable growth and environment period and a decades-long bull market. That all ended with a COVID crisis, and COVID was a supply shock like no other experienced and led to a huge swing in production capacity and other factors which I'll be going through shortly. We're now entering a world driven by supply shocks, and the traditional central banking tools no longer work as well and in the same way as before. So now an increase in the policy rate, they're not going to unlock a supply constraint to cause inflation to fall. So central banks now face a very difficult trade-off. They either live with higher inflation or they have to crush demand to get down to their inflation targets. If we can move to the next slide, please. So the trade-off I described is not new. It's always been the case. So to control the volatility of inflation, that implies less control on the volatility of supply and vice versa. However, in a world driven by supply shocks, it is a much worse trade-off. And in this high macroeconomic, this high macro volatility regime, it's not so much of a trade-off between inflation and growth, but inflation and recession. So in this picture, we move up and to the right. So the supply shock driven world, it means that we do not have the same easy trade-off that led to that decades-long bull market across all different markets. So today I'm going to try and unpack some of the causes and effects of this over the next handful of slides. If we can move to the next slide, please. So first to our catalyst for this new regime, which was COVID. So we had production capacity becoming very severely constrained. We had a smaller labor force. We had an energy crisis. We had a huge change in spending away from goods, away from services to goods. And we don't see this reverting anytime soon. So not only do we have fewer people working, but they're working in the wrong sectors. We have a much less efficient matching between the people seeking jobs and those jobs that are available. So how big is this problem? Can we move to the next slide, please? So the red line here shows US growth as well as its pre-COVID trend in green. And our estimate of what the US can produce is that pink dotted line. So it's much below where it was heading pre-COVID. This is the supply. This is the constrained supply. The problem we face is that current GDP is above that level that can be currently supported by production capacity. Our estimates are that we will need to see something like a 2% fall in growth over the next year or so, or something like 3 million jobs in the US, and this is a very large number. This is what central banks will need to engineer to rein in inflation over the next years by crushing demand. And in Europe, we also have an energy crisis, which is amplifying this trade-off, and we therefore expect a deeper recession, making production costs higher, as well as pushing down demand. If we move to the next slide, please. This is what we see as a net result. Central banks are aggressively hiking policy into recession. This is the do whatever it takes approach to inflation. So we do not think they have fully acknowledged the trade-off I've described, that a deep recession is needed to get inflation back down to central banking targets. So ultimately, we see central banks pausing the hiking path once the resulting damage starts to become clear. So they will pause. Maybe that's early next year in our view, but not early enough to prevent the recession. However, they will pause before causing the very deep recession that is needed to get inflation down to targets. So inflation will come down, but it will be elevated compared both to targets and to what was seen in the run-up to COVID. So now I'm going to move over slightly and focus more on the UK. So speaking today in the middle of October 2022, A couple of weeks ago, the UK announced new fiscal measures which, well, when compared with subsidised energy bills, amount to something like a 10% amount of GDP over the next 5 years. So these measures, without forecasts from the OBR, without any knowledge of the economic impact, brought the credibility of the UK government into question and has prompted a sharp repricing of UK risk premia. So these are still very much in flux. Policy is in motion, but it's hard to get back that credibility when you've lost it. So the chart on the screen here shows where gilt yields were before the Bank of England stepped in to calm markets. And to us, this is an example of that worsening trade-off that I've already mentioned. The market reaction shows that fiscal credibility really does matter. And with high debt after COVID, it also highlights that higher rates to tackle inflation not only comes at an economic cost, but also to expose financial stability issues. So these measures cause inflation, and alongside the damaged credibility, it actually means that the Bank of England will be pushing rates higher still. We can move to the next slide, please. So not only does the UK have a widening fiscal gap, but it also has a large current account deficit, and higher than is both seen in the US and Europe on the left-hand side of this slide. With a small and open economy, this puts the pound under pressure, and that is what's shown on the right-hand side here. So not only does the UK not look in the best shape, but the recent action has actually made the situation worse. If we can move to the next slide, please. So looking further into the supply situation in the UK, the situation mirrors the global environment, as well as having some idiosyncrasies, for example, Brexit. So inflation on the left-hand side, so this is CPI, it's around 10% now. We expect it to hover around this number approximately for the next 6 months before it starts to fall. We can even see that this core inflation is running about 5%. That's where you strip away the headline grabbing food and energy inflation. Actually, these are the ones, or at least energy is where the recent policy action was aimed. So the amount of inflation is solid, even when you look at the core levels of it. So the UK, the government are hitting the gas pedal. What this means is that the Bank of England are going to have to stamp on the brakes to get that demand down to reduce inflation. And actually, before the government action on energy prices, what we saw was those energy prices were going to actually do quite a lot of work to reduce inflation, i.e. they would take away household spending, they would reduce demand, and they would help push inflation down. And while the Bank of England were going to be increasing rates, were projected to, actually that energy was going to be doing quite a lot of the work for them. So now we've had that price cap, as well as the unfunded tax cuts, that puts more disposable income in consumers' pockets. It means that Bank of England are now going to have to do more, as in they will be raising the policy rates further and quicker than previously. So all in all, the widening gap on the left-hand side of this chart shows that there's going to be more borrowing. An additional borrowing brings more financial instability costs too. An obvious example of this in the UK, as well as the US and wider, is housing markets, where meaningfully higher mortgage rates could cause more problems down the road. So this is another reason why we think central banks won't be ultimately feeling able to go as far as would be needed to get inflation down to their 2% target. So when we talk about the end of the Great Moderation and higher macro vol, the UK is a prime example of this. So what does it mean for markets going forward? So the slide in front of you now shows policy as well as equity in the US, and we can see that as policy rates have been rising, equity prices have been falling. So we do see that equities have priced in the increase in policy rates, but not in our view the economic damage that these increases in policy rates will be causing over the next couple of years. So we expect earnings to fall next year, and in fact further and deeper than what is priced in by markets. So therefore, on our shorter or 6 to 12 month horizon for equities, we are underweight. On longer horizons, however, so I think 5 years plus a more strategic horizon, this is the horizon after which that pause would have happened by central banks. And then on that basis, today's valuations look a little bit more attractive. So while we have reduced our historic overweight, we are still mildly positive. If we can move over to the next slide to focus on fixed income. So on the slide here are treasuries in the UK and the US. And what we expect is to see more term premium to be priced into government bond markets, driven by higher deficits as well as credibility concerns, certainly in the UK. So while we are underweight government bonds on that shorter 6 to 12 month horizon, both at longer and shorter tenors, we do take different views on different parts of that curve. So we prefer the short end, given the higher yields and carry that you can get. In terms of inflation-linked bonds, we do like these. We are overweight, primarily in the US, given our expectation that inflation will be settling at a higher rate than anticipated by markets. Central banks do not deliver all that is required to get inflation back down to target. And then finally, just a round of fixed income in terms of credit. We are very positive on credit on the back of higher starting yields, as well as the advantageous place in the capital structure relative to equity. If we move to the final slide, so this is showing you a figure here of our aggregated strategic horizon views from our capital market assumptions, our CMAs. These are all published on our website on a quarterly basis across a range of currencies and investment horizons. And these embed the macro themes that I've just described. And we in turn then turn those into capital market assumptions and actionable portfolio construction guidance. So the chart here shows our view of that longer term horizon, so I think 5 to 10 years, over which you would be by building a strategic asset allocation. So you can see here we have our preference for inflation-linked bonds relative to nominal government bonds, as well as a preference for credit over equity, as I've described in prior slides. So moreover, we find that a simple approach to portfolio construction, like anchoring on a 60-40 portfolio, is no longer sufficient in a world of higher macro volatility. And this volatility will lead to a more dynamic asset allocation over time. So themes on which we regularly publish research and guidance on our website. So in conclusion, this is not really an environment of being bullish or being bearish. It's an environment of more macro volatility. Until we get more clarity on that central bank pause or the lack of it, this is going to be a tough environment for investors. With that, I'll hand over to my colleague Lloyd.
Thanks, Paul. By way of introduction, my name is Lloyd Walton-Rees, and I'm an equity strategist within BlackRock's iShares business. And part of my role is to help investors navigate through our equity index offering. And as we've just heard from Paul, it's certainly a complex market environment to navigate. What you may have also heard in press recently is the disparity of negative mutual fund flows and positive ETF allocations over the course of the year. So given the current market environment, I hope to spend the next couple of minutes giving a brief overview of how indexing and ETFs in particular can support investors to deliver their objectives in these challenging times. So firstly, let's just recap on what an ETF is and some of the benefits. The majority of the UK market has become accustomed to indexing through trackers or index mutual funds, and effectively an ETF is a similar investment vehicle. It's a basket of securities that's designed to track a designated index, but with the advantage of being a tradable security in its own right. There are a number of benefits that indexing can bring for investors, and I'm going to focus on three. The first is cost. In a fee-compressed environment, indexing can offer low-cost access to markets through beta exposure, be that in model solutions, building blocks index portfolios, or as low-cost core allocations alongside high-conviction active exposures. As fees become of increasing interest, ETFs can help reduce the headline fees to build portfolios. The second is diversification. ETFs and indexing can provide access to large swathes of market exposure. With ETFs that cover up to the full investable equity universe, 2,900 securities, but even when looking to gain access to more targeted exposures, ETFs can support portfolios through both strategic and tactical asset allocation. Finally, and perhaps increasingly important in the environment we're in, they can provide liquidity, with investors able to trade intraday as opposed to perhaps some of the more restricted trading profiles that other investment vehicles may have. But this secondary liquidity can also help reduce overall trading costs within portfolios. One of the key things to recognise is how the ETF landscape has changed over the last decade or so in particular. Historically, ETFs may have only been able to offer access to core exposures in line with strategic asset allocation, perhaps the FTSE 100, S&P 500, or in fixed income, Euro govies, or investment grade. But products have been innovated to meet evolving client needs. And as this landscape has evolved, we have seen increased offerings in thematic, sustainable, factor and precision exposures. This has allowed investors to gain access to harder to reach parts of the market, perhaps China or India equity, or difficult to manage fixed income exposures such as EM local currency or high yield credit. And at a click of a button, investors can now access markets that may have been previously being restricted. As mentioned, indexing has long been used as a tool to deliver low-cost strategic asset allocations at the core of portfolios. But one of the most notable uptakes over the course of the pandemic from an equity perspective has been the increasing usage of precision tools such as sector and factor ETFs. If we look back on the dispersed market we've experienced over the course of the last couple of years, sector and factor ETFs have allowed investors to allocate tactically, be that through pandemic favourites such as healthcare and technology, or allocating to consumer staples through the course of 2022 as inflationary pressures hit. In fact, both 2020 and 2021 were coming of age for sector allocation within European portfolios, with $22 billion allocated over that period. And in volatile markets, investors have turned to ETFs for low-cost liquid market access. And this is the same within fixed income. With central banks stepping back, interest rates being hiked, and with smaller bank balance sheets post the global financial crisis, we see liquidity in underlying bond markets being challenged. And traditionally, bond markets are over-the-counter traded with no centralized venue to exchange. Centralized place, where a broad set of fixed income exposures can be traded in a transparent manner. For this reason, we've seen fixed income trading volumes at record levels year to date. 2022, fixed income ETFs have traded $3.4 billion on average per day, and that's strongly up versus 2021's $2.8 billion. So despite very challenging markets with negative returns across both equities and fixed income, investors continue to turn to ETFs in particular to help them navigate through that complex market environment. That's seen inflows of $46 billion year to date for equities and $17 billion for fixed income products across Europe in 2022 so far. This follows on from a record-breaking year of equity flows in 2021 and highlights the utility and flexibility that ETFs can offer investors as they navigate through building portfolios in a challenging environment.
Thank you, Paul and Lloyd. So one more speaker before we take a short break. And up next is Andrew Surrey, Active Distribution Lead at Vanguard UK. Now, advisors know it can be a challenge to build sustainability into a client's portfolio whilst also maintaining balance and achieving low cost. Join Andrew to hear why Vanguard works with Wellington, a leader in sustainable investing, and who they've worked with since 1975 to deliver the Vanguard Sustainable Life Fund range. Helping advisors rise to the sustainability challenge, Andrew Surrey, Active Distribution Lead at Vanguard UK.
Hello, and thank you for taking the time to watch this webinar. My name is Andrew Surrey, and I'm head of Active for Vanguard's UK distribution team, talking to you today about Vanguard's Sustainable Life range. I thought I'd start by sharing a very quick history lesson. You might have occasionally wondered, where did multi-asset come from? When did it first start? The answer to that was back in 1928. A gentleman by the name of Walter Morgan, sitting just off Rittenhouse Square in Philadelphia. He was an accountant managing money for his grandparents and a few of their friends. And with the volatility in the market back in the late 1920s, he decided to add 35% high quality fixed income into the equity portfolio to reduce the risk. And that was the genesis of all multi-asset funds. That strategy became the Wellington Management Company and the Wellington Fund. And that fund became the Vanguard Wellington Fund that's still run in the US to this day and is the largest multi-asset fund in the world. The range we're talking about today, Vanguard Sustainable Life, is the global and sustainable UK domiciled version of that same strategy. So let's have a look at the learning objectives. We'll understand why we work with Wellington, that I've talked about already, why they're a leader in sustainable investing and how they deliver great outcomes. Critically, they're great outcomes whether your client has a sustainability preference or if they don't have a sustainability preference. We believe this fund range is appropriate for all investors. They're looking for a core, low-cost, multi-asset solution, whether they have a sustainability preference or not. It is active, and they should have a preference for active management. You might be surprised to hear Vanguard talking about active management. So you can see some statistics up on the screen there. Vanguard actually is the 3rd largest active manager in the marketplace. On top of that, we're also the world's largest buyer of active. So we buy the skill set from fund managers like Schroders that we've worked with since 1981, and I'm sure is familiar to you. And we use Vanguard's scale and our ownership structure, where we're owned by the mutual funds in the US, to keep those costs low and deliver great active management to you and your clients at a very low fee. Just a quick recap on Vanguard's multi-asset solutions. I'm sure you're familiar with Vanguard's Life Strategy range, even if you're not using it, but if you are using it, thank you very much. That's also available in an MPS format now. So you can get the Life Strategy MPS Classic, which has the same asset location as the mutual fund range, or the Life Strategy MPS Global that doesn't have the home bias. On the MPS side, you can see on the right of your screen, we also have a target outcome range called Life Targets. They aim to deliver particular levels of return as opposed to target allocation. And we also have the target retirement range in the middle. There's specific target retirement dates, and asset allocation diverges towards those particular dates to manage the volatility as investors get towards retirement. But what we're talking about today is the Sustainable Life range. Like Life Strategy, it has 20% allocation differences, and like Life Strategy, it's combining high quality fixed income. They are really similar, and one of the reasons in terms of their approach, one of the reasons for that is actually Life Strategy was originally launched in the mid-90s as the index version of the Wellington Fund and the Wellington Fund range. That's why they work so well together. So here are the 3 funds: the 60 to 70% equity fund, or the 65% equity allocation fund, was the original fund that we launched in the UK back in May 2016. That's the global version of the US one. We added the sustainability criteria in December last year, so December 2021, to that 60 to 70% fund. At the same time, we launched the 40 to 50% equity fund and the 80 to 90% equity fund, as well as a 100% global sustainable equity fund run by a different team within Wellington. They're the same, essentially the same equity and essentially the same fixed income sleeves for both of them, just different, also for all 3 of them, just different asset allocation. So you can look at the 60 to 70% fund and work out how the 40 to 50 and the 80 to 90 would have done. They are Vanguard funds, so they are low cost. The OCF for the 3 funds and for the 100% global sustainable equity is only 48 basis points OCF, significantly below the market averages. That means you and your investors get to keep more of their return. It's one of the few things you can be certain about in this market, is that costs will continue to matter. So I mentioned Wellington a couple of times. It's worth introducing them properly. They have a very large active manager in their own right, 1.4 trillion. I used to translate that as about £1 trillion, but unfortunately now it's closer to 1.4 trillion pounds or so. They're our largest and oldest partner on the sub-advisory front. So we have 28 different managers that we choose for different areas of active. Wellington is our chosen sub-advisory partner for multi-asset. They're headquartered in Boston, but they're a truly global firm with over 900 investment professionals working to deliver great results across their different strategies. When you think about the firm, they're a partnership that enables them to take really long-term decisions and attract and retain the best talent. They're often making decisions, that are going to have an impact 10 years down the line, 15 years down the line. An example of that is how early they went on sustainability, ESG, and climate. So they launched their first climate fund back in 2005, 2006, and have been building out the sustainable investment team ever since. They actually have about 70 people across the entire business that work on sustainability. We'll have a look at the 34 that are relevant for this fund later on. Here's the team that managed Sustainable Life. It's led by Natalia Kaufman, who is one of the most incredible people I've ever met, a Ukrainian national, who left Ukraine, went to the States, did a couple of engineering degrees, rose to become a lead engineer at Ford Motor Company, working the F-150, the best-selling vehicle of all time. She then became an investor at Wellington and rose to become the lead equity manager on this huge team that you can see here. So you can see that the immediate team that Lauren and Natalia, Lauren's on the fixed income side and has 20 years experience managing fixed income for equity mandates. And that's a really important point. Too often we see multi-asset where the fixed income managers are trying to be top decile and the equity managers are trying to be top decile. And that combination often doesn't mean a top decile result for their overall fund. What you need is the fixed income manager to be aware they're running money for an equity mandate, because they make different decisions, keeping it high quality. So in equity drawdown periods, like the sort of markets we've been in this year, the fixed income does its job of being the foil to the active equity risk. At the top, at 12 o'clock, you can see the global industry analysts. These are some seriously impressive people. 53 global industry analysts. They're looking at the equity market. They're career analysts. It's a career at Wellington to be an analyst rather than a stepping stone to becoming a portfolio manager. So just incredible amounts of resource that you have there. Average of 19 years experience across those 53. On the fixed income side, Lauren has got around 40 fixed income credit analysts supporting her. That enables them to make lots of small decisions, creating alpha through lots of smaller decisions rather than having to take big bets and risking the whole house on whether the ECB is going to raise rates faster than the Bank of England or any big decision like that. And at the bottom, you can see the 34 sustainable investment analysts that we'll get to in a second. So how did Natalia and Lauren achieve alpha? This is an active portfolio. If you're choosing these funds, you need to make a decision to step away from indexing. This is the strategy that they're looking at. There's three parts to the equity investment philosophy. Good stewards of capital with a history of stable dividends. These are often quite boring companies in terms of return, but they just punch the numbers year in, year out. Secondly, you've got strong operators in capital-starved industries. These are industries that are unloved, unpopular, unlooked at, that are not necessarily completely starved of capital, but finding it harder to raise capital than at other points during the capital cycle. They then look for the best or strongest market leaders within those industries, because when they become popular, when the industry comes out of the doldrums, they will be the market leader, often with increased market share. And the third one is market leaders with underappreciated franchise values. These are often well understood businesses where the core part of their business is well understood, easily mappable, and probably accurately priced by the market, but they have another part of their business that's less well understood by the market. And it's effectively a free option on that working or not. And then they combine those three equity elements of the philosophy with high quality fixed income. So no high yield, only investment grade fixed income. Time and time again, whether it's over the 90 years of being a multi-asset investor or doing independent academic research, that's been shown to be the best approach to blend with equity risk. I said I'd show the sustainable investment research team, and you can see the skill you've got here. It's average of 14 years tenure across this particular screen, led by Wendy Cromwell at the top left. Seriously impressive sustainable investor. She's actually been re-elected to the board of the UN-sponsored body, the PRI, the Principles for Responsible Investing. You can see the breadth and depth of the skill that they have there in the research and strategy, in the ESG sector research, and across the climate team that we're going to touch on in a second. These are the four pillars that make Vanguard's sustainable life sustainable. They're the sustainability pillars. First one is a net zero commitment. These funds are Paris aligned to the Paris Agreement, which aims to keep global warming below 1.5 degrees. The second one is ESG risk avoidance, so excluding some unsustainable activities that some companies do. The third one is engagement with portfolio companies. Both Vanguard and Wellington believe that this is actually a very strong lever for achieving real world change, and Wellington use it to promote net zero targets with the companies that they hold. And the fourth one is good governance assessment. This has been the case for decades now within the Wellington organization. Only great companies and very well structured and run companies are going to achieve good results whether that's about profit or about sustainability principles. So there are intermediate steps that the range is going to be taking in terms of hurdle rates on the way to being 100% net zero across the fund shares and corporate bonds by 2050. The key here is that there are science-based targets. So not press releases by companies saying we'll be net zero, but where they've achieved a science-based target, from an organization like ScienceBasedTargets.org, which is an independently funded group of scientists who take a look at the plan that the company has produced to get to net zero, look at whether it's in line with the latest climate science, look at whether it's quick enough, look at whether it's commensurate with their peers, and if it is, then they get set in terms of their target. That's the benchmark, not just a press release, but not do anything for 20 years or so. So you can see 60% by 2030, 90% by 2040, and 100% by 2050 in line with the Paris Agreement. Let's have a look at how the fund range is doing right now. You can see the growth in the percentage of the portfolio that have a target set or have a target set and committed to get a target. Critically, that's been achieved not just by selling down companies that don't have a target and by buying companies that already have a target. It's been achieved by engagement by Wellington and others to make it clear to boards and to senior management why it's so important that they're transparent about their carbon emissions and start on the road to net zero and then move into the new economy that we're all going into. Second element that I mentioned is ESG risk avoidance. So you can see no tobacco production. If a company makes one cigarette, then they're excluded from potential inclusion. Also, no involvement with controversial weapons. So just for clarity, what we mean by controversial weapons, they're indiscriminate in their nature. So a nuclear weapon is obviously indiscriminate, it affects everyone. Same with biological or chemical warfare. But equally, if you have a cluster munition, that is also indiscriminate in its nature because of the nature of the time and how long that's a threat to the local population. Conventional weapons aren't explicitly excluded, but one of the complexities around this topic is that they tend to be the same companies that create controversial weapons as conventional. You can also see some exclusions around thermal coal and oil sands extraction, etc. And do talk to us if you want to understand more about those particular exclusions. So they're the four pillars: net zero, ESG risk avoidance, the engagement with portfolio companies, where the real work happens. To give you an idea, it's been hundreds of engagements that the Sustainable Life team have had with portfolio companies, in each year, where they're talking to the companies about lots of different E, S, and G issues, including promoting net zero targets to the board and senior management of those companies. And on the good governance side, companies do get excluded for poor governance practices if that deteriorates. I mentioned we'll talk about physical climate change risk. Unfortunately, because of the half-life of the greenhouse gases in the atmosphere, even if we had zero carbon from tomorrow, the next 20 to 30 years of climate change would still happen, and the risk is already baked in. So what this team here are trying to understand two things. One is how is the planet going to adapt, and they've partnered with the Massachusetts Institute of Technology to help them understand that. Where's the money going to be spent as we cope and learn to live with climate change? And then the second thing is how they assess physical climate change risk in the portfolio. They work with a leading climate research centre, Woodwell Climate Research, to do this. You can see on the left there, this tool called CERA, the Climate Exposure Risk Analysis tool, that looks at 7 different variables. You can see them here: heat, drought, wildfire, etc. On the right, you can see maps that they create. So they create them across the 7 different variables and across different timeframes. We're looking at obviously hurricane risk here for the United States. The blue dots, and this is where it links to the investment, the blue dots are physical locations for hospitals belonging to a company in the portfolio called HCA. They actually have some healthcare facilities in the UK as well. And so when they engage with HCA, they will share the physical climate risk that this company is facing in each of their locations. You can see the North Florida and Carolinas. We know they get hit by hurricanes, but that's going to become more frequent and more severe, unfortunately, with climate change. So making them aware of this physical climate risk and understanding what they're going to do to take steps to minimize that as much as possible. All of this work from the 53 equity analysts, the 40 or so credit analysts, and obviously the sustainable investment analysts, and Natalia and Lauren putting the portfolio together creates a balanced solution. What you can see here is the Morningstar 9 box. You've got value companies on the left, growth companies on the right. When you compare the balance across the Sustainable Life Fund and across the other funds in the range and compare that to the most popular non-Vanguard sustainable multi-asset funds, you can see there's much more balance in the Sustainable Life range. What happens with a lot of sustainability funds is they exclude, they lean towards companies that are what we call accidental tourists in the ESG space. So there's lots of overweights or growth tilt towards sectors like healthcare and technology, etc. That creates an imbalance within the sustainable fund, and that is why a lot of funds have actually struggled this year in 2022 in terms of performance, and Sustainable Life hasn't, with a more balanced approach across the equity and also across the fixed income universe. Talking about balance and asset allocation, you can see the risk ratings that we have here across the different major providers. You can look at that in your own time. Moving on to the risk return nature, this is probably my favorite graph. It shows the Vanguard Life Strategy range relative to all the other multi-asset funds available in the UK. So each grey dot is a different multi-asset fund. You have return on the y-axis and risk along the bottom. And you can see they form a beautiful, efficient frontier. You can also see how Sustainable Life Fund has done. It is slightly more risky, the 65% equity allocation one, 70. The Life Strategy 60, you'd expect that with a slightly higher equity allocation. And you can imagine where the 80 to 90 and the 40 to 50 funds will sit as well as they get their longer term track records. This is the performance of the 60 to 70% fund. What we have here is the graph to the end of September. The outperformance there was 21% outperformance since inception in May 2016. It's had a very good September and October with the volatility that we're having in, so it continues to be top decile in terms of its performance and a core choice for clients, whether they have a sustainability preference or whether they don't. The other funds are performing very well, and we'll better publish those performance track records in due course. So just to wrap up, the low OCF, 48 basis points, means that your investors get to keep more of the return. It's the only thing we can probably be certain about in this environment, is that costs still matter in volatility, and when it's not volatile, costs matter when markets are going up and when markets are going down. Dedicated managers since inception, just for clarity, that's not since 1928, since 2016. But the investment partnership that did introduce that, is where it's managed at Wellington Management Company. The fund's got a great performance track record and it continues to aim to outperform the market over a cycle with lower than market volatility. But do get in touch with us if you have any questions. We'd love to talk to you more about this. Thank you.
Thank you, Andrew. Well, now it is time for our coffee break. We'll be back in just 5 minutes, enough time to put the kettle on and then settle back for part 2 of our seminar. Welcome back. Justin Onyekuzi, Fund Manager at Legal and General Investment Management, is up next. And if you're sitting comfortably, he has got a story for you entitled Justin and the Beanstalk. But this is no fairy tale. In the real world, growth and inflation are rising from almost nothing to sky-high levels. Justin will seek to answer the three key questions facing financial advisors. What do recent geopolitical risks mean for inflation and our portfolios more broadly? What investment tools and techniques are available to advisors to combat the threat of inflation? And if central banks continue to raise interest rates, what does that mean for advisors? Ladies and gentlemen, Justin Onyekuzi.
$9.9, 10.1, 8.2. They are the inflation rates of the EU, the UK, and the US respectively. Investors have never seen this type of inflation for the last 40 years. So naturally there is confusion about what to do about their portfolios. My name is Justin Onyekuzi. I'm the head of retail investments, EMEA, here at Legal and General Investment Management, and the lead fund manager on the £8.5 billion multi-index funds, as well as the lead fund manager on the newly launched model portfolio range, where the headline fee is an amazing 6 basis points, 0.06 basis points, and the idea of trying to be disruptive in that model portfolio universe. This presentation is embarrassingly called Justin and the Beanstalk. However, this is no fairy tale. This is a real life story of that inflation giant stomping all over your portfolios. So what I'm going to try and do is talk to you why that inflation giant has come about and what you can do. We devised this inflation toolkit, what you can do to navigate that inflation giant. So how has that inflation giant occurred? Well, over the last few years before the pandemic, between 2008 and 2020, we saw central banks trying to generate inflation, right? So, actually post 2020 has been a very different environment than it was pre-2020. So post financial crisis in 2008 until 2020, policymakers were trying to generate this inflation giant. And they tried lots of things, right? They tried low interest rates, they tried quantitative easing, they tried to mess around with the inflation target, but no matter what they did, no matter how much water they threw on that beanstalk simply did not grow. Then post 2020, we saw three key magic beans, and these magic beans have incited that beanstalk and woken that inflation giant. The pandemic, unprecedented monetary and fiscal policy, but importantly used in conjunction with each other, which they hadn't really been done since 2008. And then the commodity crisis, really driven by the war that we've seen in Eastern Europe. And that has caused that beanstalk to start growing, and you started to see inflation start to arise, that inflation giant starts to occur. So let's talk a little bit more about these beans. First, I mentioned the pandemic, and the big challenge around the pandemic was that you saw the global economy closed. The global economy effectively shut down, but then it opened up at uneven rates. Really, really important. Opened up at uneven rates. What did this mean? It meant that when certain economies were open, they couldn't trade with other economies that were closed. And that meant there was a scarcity of goods, and that meant that pushed the prices of goods up as there were a limited supply of those goods overall. The UK was one of the first economies to open, and they were demanding goods from the rest of Europe, from Asia, and in particular you saw this build up in prices in chips in semiconductors, in cars, in computers, in most electronic goods. There's been a shortage of goods a shortage of chips right across the world, driven by this uneven opening of economies overall. And what you can see here is a UK CBI survey where they talk about the stresses that they've had on production, and you can see we've seen the largest shortage of production according to this survey since the 1970s. So it's no real surprise that we're seeing the highest inflation levels for those goods since the 1970s as well. The one thing which is really concerning is this light blue line you see. That's the shortage of labor. What does that mean? It means that essentially people are struggling, or companies are struggling to get bums on seats. So what does that mean? It means they probably have to push up wages in order to attract the talent. And then you get into this kind of, again, you can see it's the highest level of shortages since the 1970s. But that's when you get into this kind of spiral of doom, in a way that inflation's high and therefore wages go higher, and therefore the goods get more expensive again, and therefore wages get higher again. That inflationary spiral of doom, which we're trying to avoid, which is why the labour market is really, really important when thinking about structural levels of inflation. So the first magic being the pandemic and the supply constraints it caused. The second magic bean is gross household income. So essentially that we saw fiscal and monetary policy being used combined during the pandemic. So if you look at gross disposable income here, you see Europe and you see the UK, and you see they're on this trend line pre-pandemic. So pre-2019, gross household income is on this kind of this nice trajectory up, as you'd expect income going up as we get as growth goes up. However, what the pandemic did, it caused in the UK and Europe, it caused this kind of fall in gross household incomes. However, then governments came in with fiscal policy. A lot of monetary policy was going, there was still quantitative easing, printing of money, but fiscal policy was used in combined with monetary policy to get us back onto this trend growth in terms of income. In the US, however, they simply gave people too much. They gave people too much money. So people effectively were getting paid more from sitting at home than they were before the pandemic. And actually, by the end of 2020, you're talking about household incomes being 10% higher than they were before the pandemic, despite the economy being locked down for a lot of 2020. So significant fiscal policy, when combined with monetary policy, what did that cause in the US? It caused this greater demand, and a demand boom in the US caused greater demand for goods, and that led to, or has led to, this increase in prices, particularly of goods, that we've seen since the start of 2020, but as we've got into 2021. The last magic bean is the war in Eastern Europe, and we've seen, you look at the energy stresses that we've seen in the markets, but also it's right across the commodity complex that we've seen these increases in prices. And I think this graph, this chart, this illustration shows just why you've seen this higher level of prices across that commodity spectrum. It's not only in energy that Russia is a big producer across the world, but also in metals and mining, so industrial metals, in precious metals, in agriculture. Russia is pretty much top 1, 2, or 3 right across the commodity complex in terms of production. So if you cut Russia off from the rest of the world, clearly you're going to see a lower supply of commodities, and therefore you're going to see price increases overall. So those 3 magic beans: the supply constraints from the pandemic, secondly, monetary and fiscal policy being used in combination, and thirdly, we've seen this increase in commodity prices caused by the war in Eastern Europe. So that inflation giant is here. Fee, fi, fo, fum, I smell the blood of an Englishman, or UK man, I should say, or woman, I should say, actually, just to be politically correct. You see the headline rates of inflation in the UK, getting towards those double-digit levels that we see. So 10.1, as I said today, huge amounts of inflation, the highest levels we've seen since the 1970s. And that's headline inflation, including, energy and food. So headline inflation includes energy and food. Core inflation extracts energy and food, but even there you see this rise in inflation to really high levels that we haven't seen since the 1970s. So that inflation giant is here, and it feels like he's here to stay for a while. But the story isn't just about inflation, it's also about recession. Given we've seen such high levels of inflation, we've seen central banks reacting to that, putting their foot down on the brakes, increasing rates to try and quell this inflation giant. Then we have to ask ourselves, does the story inevitably end with recession? Do we see a happy ending, or do we see the story inevitably end in recession? And what we try to do here is we looked at the different rate hiking cycles from the Federal Reserve, so the US central bank, the biggest economy in the world. And we said, every time we've seen the Federal Reserve hiking rates since the 1960s, what has happened to growth, what's happened to inflation, what's happened to the economy? Has it eventually gone into recession? And what you can see here, we see 12 different hiking cycles since the 1960s, and you can see that 3 out of 12 of those scenarios, the Fed have managed to engineer a soft landing, so managed to avoid a recession, or managed to avoid growth falling overall. However, never when this inflation giant has been so big has the Federal Reserve been able to avoid a recession when hiking rates. Really, really important. And never when unemployment has been so low. So it implies the Federal Reserve have to go harder on the brakes, which means that actually it's very difficult to avoid a hard landing and therefore a recession. All very bleak there, but however, there is a glimmer of light. There is an inflation toolkit that we've designed, really designed to help advisors navigate the inflation dynamic in order to mitigate some of the losses that you tend to see with inflation overall. So try to protect your portfolios from that inflation giant. And there are 4 steps to navigating that inflation giant. The first one isn't really a step, it's more just thinking about the overall portfolios, and it's that you have to prepare your portfolios rather than predict inflation. Economists, experts have been notoriously poor at predicting what inflation is going to be. I think the stat is, if you look from 2013 to 2020, and you look at the quarterly inflation rates, what the actual inflation was, and what it was predicted to be by experts and by consensus, and you add up the difference quarter on quarter, then actually the cumulative miss between 2013 and 2020 was around about 8% difference in what inflation really was versus what the experts said it would be. So huge divergence there in terms of that inflation dynamic. So prepare your portfolios, don't predict. Prepare your portfolios for different inflationary scenarios. Then we get into the steps, and the steps are really, what you have to do for your, or what you can do to navigate this inflation giant in your portfolios. We're doing it in our strategies, so we thought it's only right to try and share that with advisors. We try to keep it simple so that everybody, even if you're using very simple strategies, very simple funds, can navigate this inflation giant following these steps. So the first one is to think about that bond equity correlation. So we know that bonds have seen the worst performance really in history. If you look at the Bloomberg Global Aggregate Index, the H1 saw the worst drawdown we've ever seen in the bond market since that index began in the early 90s. However, that really isn't the important thing to us. The important thing is, how has equities, how have the other asset classes performed relative to bonds? I think that's where the big challenges have arisen. So here we look at the equity bond co-behavior since 2020. Let me explain. So what this looks at, it looks at when equities, so the S&P 500 US equities have fallen by more than 1% in any particular year, and then on average what bonds have done in that particular year. So all these negative bars are showing that when equities have fallen by more than 1% in a particular year, bond yields have fallen as well. So bond yields falling is bond prices rising, remember. So as equities have fallen by more than 1%, all these negative bars are saying that bond prices have risen overall. So bonds have provided protection relative to equities in portfolios. Looking at the US equities and US bonds here. However, as we've got into 2021 and 2022, that protection has somewhat disappeared. And actually what you're seeing now, or what you've seen in 2022, is that bonds and equities have moved more in the same direction than in the opposite direction. Bonds have not provided that protection. So what can you do in portfolios? Diversify outside of the US into other bond markets. So think about Australia, think about New Zealand, think about Korea, think about Europe, think about other areas. So when you show this chart and you've got a diversified bond exposure, actually this positive bar gets less and less and less. So that's that bonds have provided more protection relative to the equity market when you diversify your bond exposure, but also diversify your equity exposure as well. So diversify your bonds is a key way to mitigate some of the losses that we've seen in this inflation dynamic. The other thing to consider is what local inflation is, so what inflation is in the UK versus that overseas. The UK traditionally has had a higher inflation rate than their other developed market neighbours, so particularly the US and Europe. And we think, given that the UK doesn't manufacture as many goods as our European neighbours, particularly some of the bigger countries in Europe and the US, it means that we are an importer of inflation, and that could mean that the UK is particularly susceptible to inflation risk. And we've seen just what happens when inflation expectations do start to spike in the UK over the last few weeks, what that can do to the volatility of sterling. So what this chart shows, it shows a 60-40 portfolio, so 60% equities, 40% bonds, without foreign currency, the dark line, and with foreign currency, the light blue line. We've shown 2016, but actually we could have shown 2022. And what you see is that around that Brexit vote, as we know, sterling sold off aggressively. What happened around that time? Inflation expectations spiked in the UK relative to the rest of the world. So therefore, having that overseas currency exposure just gives you that extra diversification, allows you to spread that risk over different currencies, and therefore reduces the risk of being prone to one particular market in terms of inflation versus the rest of the world. And the right hand side just shows that as you get to the more risky strategies, actually you can take more overseas exposure risk. Why? Because equities tend to be quite volatile. As you get to the higher risk portfolios, they tend to have more equities, and therefore having something that's volatile next to it helps to give that diversification overall. How can you do this in your portfolios? If you're not investing in our funds, where we can use futures and forwards to try and change that currency dynamic, you can buy hedged and unhedged strategies in order to try and manage your currency exposure overall. And last but not least is to think about your investment objectives. Don't throw the baby out with the bathwater here. Clearly, inflation is a big challenge, but we also have recession that we believe is going to come in the middle of 2023. We think it's very hard, as we showed on a few slides before. It's very hard for central banks to avoid recession when hiking rates and when hiking rates so aggressively. But in order to think about the inflation dynamic, think about both long-term and short-term hedges. So from a short-term perspective, you can think about things like commodities. I mentioned commodities, great inflation hedge. Inflation-linked bonds, so relative to non-inflation-linked bonds, clearly that inflation linkage will give you some protection relative to bonds, relative to non-inflation bonds. However, still, do expect to inflation spikes, you're going to lose money in the bond market overall. But there are long-term inflation hedges. I think that this is where we are now. We've seen that short-term inflation spike. So what are the asset class that are going to give you that long-term inflation protection? Equities. Why? Because companies can pass on the price increases to consumers, and therefore, typically equities over the long term will trend upwards with inflation. Then you have listed alternatives, things like REITs, and REITs do look attractive from a valuation perspective. I think it's very difficult to argue that from a valuation perspective purely. But also you think about the inflation hedge. Companies, property companies, or rents that property companies will manage tend to be linked to inflation, and therefore you get that inflation linkage over time. And there's listed infrastructure. Infrastructure, tends to again have exposure to subsectors like toll roads, like airports, like railroads, and again they tend to have linkages to inflation as well. So those types of asset class can give you that inflation hedge. But say, do not throw the baby out with the bathwater. There are lots of other risks to consider. The concentration conundrum, and this is really where a handful of stocks now are dominating the US equity index. Most investors go passive, invest in the US on a passive basis. So having a significant amount of stock concentration building up in the US is a big challenge. One thing you can do is spread your risk across different regions, diversify over the entire equity market to reduce that stock specific risk. This is a concentration conundrum, and I think it's going to become more of a theme in the next few months. Suitability again is really important, as you know, as advisors. Really important is that as the equity bond dynamic, as inflation really starts to bite, there's an extra element. I think it's an extra value from advisors to really sit down with their clients and talk to them. And lots of advisors that I'm seeing up and down the country are doing that. And again, really important to not just follow a risk profiling model. Really, they do a really good job, risk profilers and the quant tools that back them up. But that qualitative overlay, I think, is becoming more and more important. From a liquidity perspective, I do think we're going to continue to see challenges with liquidity as you move into the recessionary environment, and that is particularly relevant for a retail investor. And I've already spoken about the economic cycle. I won't touch on ESG because I know that you've heard about that so much, but I think it's really important going forward that advisors don't look at the financial objectives and financial returns, but also some other considerations that may be interesting for their client as well. So that is me with a green hat on, really broad shoulders and an axe. I don't typically carry around an axe with me. I seem to have lost my neck on this picture and it looks like I've been to the gym because I'm a lot broader than I usually am. But as I said at the beginning, 9.9, 10.1, 8.2, these are the inflation rates of the EU, the UK and the US respectively, the highest levels that we've seen in 40 years. And you have to try and navigate that in your portfolios. I've shown you an inflation toolkit, which helps you to do that, helps you to navigate that inflation and stop that inflation giant stomping all over your portfolio. My name's Justin Nokasi. I'm the head of retail investments here at LGIM. Thank you so much for listening.
Justin Onyekuzi, ladies and gentlemen. Next up is Olivia Geldenhuys, investment specialist at Schroders. Olivia is taking a look at some of the challenges that advisors face with sustainable investing. She'll outline her views on the divestment versus engagement and what she thinks are some of the important requirements when investing sustainably. She'll also uncover if there's any difference between sustainable investing and successful investing.
Hello, everybody, and welcome to this session by Schroders Investment Solutions talking about all things responsible multi-asset investing. I'm going to be with you for about 20 minutes, and I really want to take you through some of the talking points that advisors have when it comes to responsible and sustainable investing. And the first thing I'd really like to have a look at is around the challenges that advisors face when it comes to sustainable investing. Obviously, it's quite a hot topic at the moment, and I'm sure you've got lots of clients who are asking many questions about how this works in practice. And really, I think what's important when it comes to the challenges that advisors face is how much conversation is actually happening around sustainable investing. And this is just a survey done by Schroders around people who are talking about sustainable investing and what are some of the issues that they're actually looking at. And so as you can see, I've got a couple of numbers up on screen, and really it's about trying to understand where profit meets purpose. And I'm sure that, you know, from a financial planning perspective, this becomes quite a difficult conversation to actually have. So we've got people talking about something that's very topical, it's often close to people's hearts, but how do you actually have that conversation with your end clients? And I think this is where really one of the challenges actually comes in, is how do you have the conversation in a way that is constructive to someone's financial plan without making them feel that they should be specifically investing in sustainable products, or whether they should be investing in something else that meets their needs. And so obviously there's a lot of pressure in various different areas of the market when it comes to sustainable investing. And we're really starting to see that social consciousness creep up in various different aspects. And I think one of the things that is very difficult is around those investor expectations that we see. And so at the moment, you know, you might be asking your clients about sustainable investing. How do they feel about it? How do they want to invest from that perspective? And I think really getting to grips with what their expectations are is really, really important. And I think something that quite often happens when it comes to sustainable investing is we have these open-ended questions where we say, do you want to invest sustainably? And I don't think that we'll ever really have anyone who comes back saying, no, they don't want to invest sustainably. So I think it's really an important conversation to have with an open mind, to be able to talk to clients about what their feelings are around this, how strongly do they feel about that, and making sure that we actually have good understanding of what those expectations are. So because we have all of these challenges that advisors are facing when it comes to sustainable investing, I think it's really important to partner with someone who can lay out what the plan is when it comes to sustainable investing and know that you've got someone that you can trust who's going to guide you through this process. So from a Schroders Investment Solutions perspective, what we do when we are looking at building out our sustainable portfolios is we start at the very top with our capital market assumptions. And what those entail is actually taking climate change into account when it comes to designing those return expectations for various asset classes. And we do this through a three-step process. So the first thing that we look at is we look at the physical costs around climate change and how we might actually see the costs of that changing as temperatures are increasing around the world. We then have a look at something called transition costs, and this relates to your carbon taxes that will come into place and anything that will actually require economies to transition into a more climate-friendly environment so that we can generate those returns. And then lastly, something that's very interesting is around stranded assets. And this is certainly something that investors are really worried about at an institutional level, because this is anything that is essentially left in the ground that won't be able to be used within that specific economy. And so obviously something that's quite interesting in that space is around fossil fuels and how those are potentially going to be left in the ground and not actually be able to contribute to the productivity of an economy. And so all of these factors really come in to actually look at what productivity growth looks like, how does that affect inflation in those different regions, and ultimately that's what translates into our long-term asset class expectations. And so we use this really as the foundation for understanding some of the ESG factors that are going to take place when it comes to sustainable investing. And importantly, we actually use these assumptions across all of our portfolios so that we're taking that into account because it's going to affect all investors, not only sustainable investors. And so something that we then look at when we think about our repeatable process of investing with companies, specifically from a sustainable perspective, is we look at all of the different areas that you can take into account. And at the highest level, we really focus on ESG integration. And I think this is something that's really critical because it's about understanding the risks within the E, S, and G spaces and being able to compensate for those if necessary and take those things into account in actually determining the return that you can generate from those specific companies. And so that's integrated at all of the different levels, and we do that through surveys with our fund managers as well as with the underlying funds. And so something that we'll do at a fund manager level is actually understand how does this business think about ESG, how do they think about those risks, how do they take those into account in their process and in their general business. And then we look at it at a fund strategy level to understand how does this fund think about ESG, what are the specific companies that they're investing in. And so by and large, we've got a screening that takes place when it comes to sustainable investing. And then there's two different themes that you can actually take active investments in. So either you can look at something that is around the sustainable investing, that's more thematic, it's about positive tilts, or you can look at something that's more targeted around impact investing, where we'll typically tie that to your UN SDGs. And so we have a look through all of these different factors in determining what our sustainable investment styles will actually look like and when we build those portfolios for financial advisors. And I think that it helps to know that this is the process that we're going through on a regular basis. We're really getting into the nuts and bolts of how this functions within the investment space so that any of those concerns that you have as a financial advisor and any of the concerns that your end clients might have, you know that that's being dealt with a large amount of resources dedicated to understanding how this will impact investments over the long term. And so at the very high level, we really want to think about that ESG integration and how it affects all of the different stakeholders within an investment structure. And all of these different stakeholders, as we range from employees through to regulators, the environment, it's important to have a good understanding about how that's actually integrated in each of those different things. And I think it's really at this ESG integration level that we start to see the difference between engaging with companies and driving that change. Something that's really important from a Schroders Investment Solutions perspective is actually generating real world change within our portfolios. And so divestment is something that you'll often hear people speak about. And I think it's if you are wanting to target something within that range, that divestment is the right route for you. But ultimately, we view it as an escalation process. And that all starts with engagement and having a good understanding of what's happening in that company, what's driving management, and that really helps us to institute change within those companies. And because we can do that at a higher level with greater resources, there's more firepower behind this, it makes that lasting impact. Something that we discussed at the in-person event on the panel was around how you can collaborate with other asset managers to drive this change forward. I think something that you might get as a question from your clients as an advisor is around what are the differences between successful and sustainable investing. And I really just want to touch on two key areas here. And they're kind of myths that you might hear when it comes to sustainable investing. And it's certainly based off of the history that we've seen to this point. And the first question we've got there is there a trade-off between performance and responsible investing? And I think it's an interesting topic, because if we look back several years ago, that was really what people viewed sustainable investing in, is that you would need to take a cut in your performance in order to achieve the sustainable goals within your portfolio. And I think we're starting to see a shift as ESG becomes more prominent in the investment markets, and how we see more and more people integrating this into their process. Ultimately, you always want to invest in a sustainable company, and it's now the fact that we're taking ESG considerations into account in building portfolios that makes it slightly different from only looking at the financial aspect of things. And so I think, I don't need to remind anyone, but it has been a bit of a difficult time over the last couple of years when it comes to sustainable investing. And that's really as the world is starting to change, and we're starting to see that move to a more sustainable future. And so there has been a lot of volatility. There's a natural growth bias when it comes to sustainable investing, as those are the types of companies who are being disruptive. They're trying to change. They're trying to create a better future. And so it is something where it's interesting, where we've seen that volatility over this period, but over the long term, it is something that we expect all portfolios to actually benefit from. The second myth that we've really seen is that sustainable investing is expensive. And I think because it's something that's become more mainstream, we're seeing more fund managers present this, we're seeing more people being interested in it, that naturally has an effect on how much this actually costs. And so when we're building our sustainable portfolios, cost is obviously a part of it, but I think we also have to appreciate that there is a cost to sustainable investing, and that as we move into this type of environment, that we are going to need to pay for those types of outcomes. But importantly, when designing any portfolio, and I'm sure you can appreciate this in your own financial planning, is that it's about the value that you get from the cost that you're paying. And importantly, people who are looking for sustainable investment, who are looking to move into this direction, it's very much a long-term game that we're in, and that long-term focus is going to be critical. A big part about sustainable investing, because there's so much jargon, because there's so much information, is really about how we're able to support advisors through this conversation. And I can imagine you would have 100 clients, and you could have 100 different sustainable portfolios available based on the various shades of green that they may or may not be interested in. And so I think being able to support you in these conversations is really important, because again, if we have more people investing in a sustainable manner, and we're focused on this type of trajectory, it's important to have the right stories, the right information that you can trust. We know greenwashing is a big issue. And so really we've done a lot at Schroders Investment Solutions to provide that information to financial advisors who can ultimately have those conversations with their clients. And so ultimately, clients really want to understand what impact is their sustainable investing have. And we do have a useful measure within the UN SDGs. It makes it a more tangible conversation to have with clients. It's very clear the different outcomes that can be achieved with those SDGs. And we're seeing more and more funds align with these types of SDGs, where they can actually present to clients what are the goals that they're targeting, how are they investing within that space, and what is the change that they're driving in each of those different areas. And so what we've done at Schroders Investment Solutions is we've made use of something called SustainX, which is a Schroders proprietary tool that's been developed. And it's developed in-house, it's won a few awards, and really it's a proprietary tool based on academic studies. And we've taken a lot of information, we've understood all the different stakeholders, how everything is being affected, and what are those actual financial costs associated with it. And so what SustainX aims to do is actually quantify the impact that a portfolio has in dollar terms or pound terms. And that's where I think it becomes a lot more tangible, because you can hear lots of good news stories, you can see change being driven in specific areas, but being able to quantify that becomes a really important and a quite influential conversation to actually have with your clients. And so what we aim to do is we aim to generate something that is a client-friendly report. It's looking at what is the actual positive implication that the sustainable portfolio has on people and planet. And so what we produce on a quarterly basis is something that shows, as you can see on screen, a 4.53% positive impact in the world. And I encourage you to go and have a look at our at this reporting on our website, where it details exactly how do we actually calculate each of these different contributions and what are the factors that we look at in terms of influencing people and planet. And then you can also see at the bottom there, we've tied that to the UN SDGs. So again, you can have that talking point where you can allocate it to specific goals that that portfolio is targeting. And so just a little bit about, if you haven't heard of Schroders Investment Solutions and the portfolios that we provide to financial advisors, I'm specifically going to touch on the sustainable ones, but it's a range of model portfolios that are available on several platforms. And the purpose of these portfolios is to work to a real world change within the world. And so they're a more transition type of portfolio that you can access. We don't have exclusions where we're specifically disinvesting from certain sectors. We really want to invest in sustainable leaders, and we want to promote that real world change into the future. And so we provide a range of portfolios across the risk spectrum, depending on how much risk you would like to take in that portfolio, and obviously the amount of risk that is suitable for each client in order for them to achieve their financial goals. And so if you do want to know any more information about that, please do get in touch.
Thank you, Olivia. Up next, we have John Husselby, Head of Multi-Asset at Liontrust. John will discuss if it's wise to choose multi-asset funds and portfolios driven mainly by client segmentation, and from an investment perspective, what the differences are between multi-asset funds and portfolios. He'll look at key factors advisors and their clients should be thinking about when choosing a multi-asset fund, and discuss the recent challenges of managing risk profiles with changing volatility. Discussing the pros of multi-asset versus funds, John Husselby, Head of Multi-Asset at Liontrust.
Hello, and thank you for joining me. It's been a great pleasure to be part of AJ Bell's multi-asset conference, and today, as managers of both multi-asset funds and an MPS, I'm going to run through perhaps some of the regular questions that we get asked by advisors in making the choice between our range of managed investment funds and also portfolios. So let's begin with the first question. Firstly, when we talk about client segmentation, we perhaps usually think about the minimum or the maximum size of investment. But the minimum size of investment, where you're thinking about a multi-asset fund or indeed a portfolio, is very low for both. Clearly determined by the choice of platform, but typically from nothing to £500, £1,000 is a typical minimum size. But what about the maximum size? Well, a few years ago, we carried out some market research amongst advisors to see what size of fund they would recommend for a multi-asset fund versus a portfolio, what size of investable assets, I should say. When we looked at that survey, the results basically came back and said that 47% of advisors would recommend a multi-asset fund with investable assets of around £50,000. However, with investable assets of £100,000 up to £250,000, 61% of advisors said to us that they would recommend a managed portfolio service. However, in my experience, the size of investable assets is just one of many factors that an advisor will consider when recommending the choice between a multi-asset fund or a managed portfolio service. But as I say, at the end of the day, and to use one of those old cliches that we all like in this industry, it really is a case of horses for courses. From the investment perspective, I believe there are far more similarities than differences when we're thinking about multi-asset funds and an MPS. Well, that's certainly the case that we can claim when we're thinking about our investment approach and philosophy. Now, we're offering a range of target risk multi-asset funds and portfolios, and our investment approach when managing these solutions is exactly the same. We're top down. We basically think about the long-term suitability being guided by a strategic asset allocation, and then we take tactical tilts. Our tactical asset allocation is where we seek to tilt towards cheap assets with the aim of maximizing returns over the medium term. The marginal differences between what is a product and a service really very much come at the implementation stage, where, of course, an MPS is perhaps more limited, but certainly not restricted by those funds which are available on each and every platform that an advisor will choose. Now, for many platforms, whilst they offer a good range of funds, many of them will not allow you to access listed securities. And when I'm talking about listed securities, I would say closed-ended funds and obviously, more importantly, ETFs. In the past, we had the situation where a multi-asset fund had the ability, and by the way, not always the advantage, I would suggest, also to hedge out currency, to take the currency risk out of overseas investing. These days, even that has changed. Many of the fund managers that we deal with, where we want to hedge out currency exposure, will offer that hedged or unhedged share classes. Now, my colleague often uses an analogy to describe basically the differences and similarities in terms of a multi-asset fund versus a multi-asset portfolio. And he uses that analogy of a restaurant, your favorite restaurant. Do you want to eat in or do you want to take away? Whilst you certainly get a different experience with both, your choice of food will be cooked in with the same great ingredients and in the same kitchen by the same chefs. At Liontrust, we have a very easy acronym for this decision. We call it TMS. T is for transparency, M is for value for money, and S is for suitability. Once again, whether it's a multi-asset fund or an MPS, the advisor and their client want first-class administration, they want a first-class service, and when it comes to performance, they want performance in line with expectations. This is very much captured in TMS: transparency, value for money, and suitability. When an advisor outsources the investment solution, we see it very much as a partnership. They need ongoing transparency of our investment process. It's a vital part of building a relationship between themselves, their clients, and their investment manager. Value for money, it goes without saying, is important. Whether a client invests in a multi-asset fund or an MPS, whether they prefer to invest mainly with active managers, with passive managers, or even a blend, what they are looking for and what they demand is quality at the right price point. And finally, suitability. That means both initially and also ongoing. So when a client's risk profile changes, there's a range of options available to them so they can move efficiently and effectively at minimum cost, either to a higher risk profile or to a lower risk profile. Perhaps they want to change their opinion on active versus passive, but they can do so in that manner. Well, I know I will not be the first to say this year, and indeed probably this week, that it has been a challenging year so far. We've had to navigate not only inflation as a result of result of COVID, the lockdowns and the aftermath of that, but then earlier this year, the unexpected war in Ukraine, which has had both a further effect on food prices, energy supplies, and creating more inflation. And more recently, particularly in the UK, of course, a mini budget in the UK, which has caused turmoil for gilt yields and also the pound itself. In the past 6 months, it's been an extremely painful period for all portfolios, for all asset classes. Perhaps, I suppose, with the exception of cash on deposit, that has been a safe haven. But really, in reality, when you think about cash as well, of course, in real terms, it's been very negative. In times of uncertainty, markets tend to be driven by sentiment. The emotion of investors will swing violently in either direction over the short term. We believe that is when process becomes important. It's process, not emotions, that should drive your investment decisions over the long term. By having a process and a philosophy where you have conviction, so you've got a belief, and you also have courage, you have courage in that belief to stick with it, is how you basically maintain suitability of risk profiles over the long term. Now, higher volatility is expected to remain with us, I think, for the foreseeable future at least. And we believe that a diversified portfolio with multiple sources of both risk and return will become more important today than perhaps it has been over the last decade or more. There's a growing consensus that we are in the beginnings of a real regime shift, a generational one, and weaker international relations will lead to further contraction of globalization. It's fair to say, I think we are now in a period of higher, not high inflation, a period of higher inflation, which central banks, and they've already beginning to show this, will probably need to continue to act more aggressively to bring it back down. And of course, in doing so, they will risk a recession, whether that's a soft landing, as they rather hope, or a hard landing, time will tell. However, it's always fair to say that from a crisis always comes opportunities. And markets, whether we're talking about equity markets or bond markets, it's relatively easy to say today that they are far more cheaper than they were at the beginning of the year, or indeed even 12 months ago. There will be a recovery. I wish I could tell you when, but there will be a recovery. And, but there again, who really does know when that recovery will come along? As an investment manager, and indeed, advisors too, alike, we should all be prepared for when that recovery comes, because what I know is that the markets turn very quickly and far quicker than you will have the ability to reinvest back into the market. Now, the last decade or so, the real so-called outsourced winners, in terms of that winning, held a lot more US dollar assets, whether that is in equities or in bonds, than others. And really, I suppose the diversification of perhaps a more traditional multi-asset fund or portfolio by geography or by investment style, that diversification was less important over the last decade. But going forward, we believe a well-diversified multi-asset fund or portfolio will be the best placed to capture that recovery into the future. Thank you again for listening. I'll now hand you back to Danny.
Thank you, John. Now it is time for our penultimate speaker, Laurentis van den Worm, investment specialist at Timeline. In this session, Laurentis will look at how MPS compares against the average multi-asset fund from a cost perspective. He'll look at the see-through benefit of model portfolio solutions and discuss if they do enhance accountability and transparency in the industry. He'll look at the main tax advantages and disadvantages of using model portfolios and assess if they're more suitable for a tailored decumulation strategy. Laurentis, over to you.
Morning, everyone. My name is Laurentis van den Worm. I'm the investment strategist at Timeline Portfolios. Now, as mentioned in this session, we will discuss differences between model portfolios and multi-asset funds. Now, there's some irony in me being part of this whole conversation because, to be 100% honest with you, a year ago, I was not even familiar with the term multi-asset funds. Now, some of you might wonder, how's that even possible for a finance professional in the UK markets? Well, before joining Timeline at the start of the year, I was working in the South African capital markets, and the way that mutual funds are being run in South Africa is slightly different than in the UK. It's mostly just terminology issues, but there are some structural differences as well. In any case, here I am today, 1 year later, running model portfolios in the UK and talking to you about MPS versus funds. So what we will do in the next few minutes is just looking at a few factors that we need to consider when choosing between multi-asset funds and model portfolios. Now, in this session, we will talk about costs, transparency, tax advantages, disadvantages, flexibility. We will start off looking at how does our MPS compare against the average multi-asset fund from a cost perspective. We will then look at how does the look-through benefits of model portfolio solutions enhance accountability and transparency in the industry. Then moving towards taxes, what's the main tax advantage or disadvantages of model portfolios? And lastly, I think we can all agree that flexibility is highly valued by most advisors in the industry. Well, we will look at whether this is something that carries any value in the way model portfolios are being managed. And I think just before we go into these four factors, we need to ask ourselves this one question. Is there a difference between model portfolios and funds? Now, for an investor that wants to have market exposure through traditional assets, I think there really isn't any right or wrong answer whether you invest in MPS or funds. I believe 95%, if not more, of all investment strategies can be covered within an MPS solution or within a fund solution. It is really at the extreme ends of the tail, and I like to show this as a bell curve, just showing you that most of the investment strategies can be captured by MPS or funds. It's really in the extreme ends of the tail where one might find a fund or an MPS more suitable. For example, if you are looking to take a tactical position with unconventional assets, currency overlays, or derivatives on a portfolio level, then an MPS might not be the ideal solution because you will have to do that on underlying fund level, and you really don't want to make all these changes to underlying funds from an MPS point of view. On the other side, you might have the preference for model portfolios due to the added services that usually comes with it. We often speak about MPS solutions being a service and funds being seen as a product. It might be these additional services that you want to capture in your investment practice. Now, some other advantages of an MPS might be that you want these added flexibilities around tax planning. It might be the way that you it might be a solution for you to drive down fees. But that said, at the end of the day, both products, funds or MPSs, provide a structure for investors to maintain a robust investment philosophy. So moving on to funds or MPSs from a cost perspective, how does model portfolios in general compare against multi-asset funds in the UK? And I think there's really two sides to this story. First of all, we at Timeline, we do create a multi-asset fund report once a year, analyzing 96 multi-asset funds in the UK universe. And this is a great way for us to see how our portfolios at least stack up against the masters of the universe. And what you see on the screen is the findings of the latest 2022 report. The average multi-asset OCF in the market comes in at 97 basis points. The median OCF in the market not far off, coming in at 95 basis points. And then the lowest OCF in the market coming in at 19 basis points. And then on the right-hand side, our Timeline Tracker portfolio, just a low-cost market tracking portfolio ranging from 100% fixed income to 100% equity, coming in at 8 basis points. So why am I showing you this? It's just to show that we can pool a large amount of assets under an NPS solution, and this gives us institutional buying power, allowing us to create portfolios at 8 basis points. But then there's another side of the story, and I think that's the fact that the whole NPS industry is still very much smoke and mirrors. So what you see on the screen is the research done by Nextwealth, and it's just showing you the NPS chart on the x-axis and the average portfolio OCF on the y-axis. And this just shows you that it's not necessarily a general theme for NPS solutions to be cheaper than multi-asset funds. Yes, the average OCF is cheaper in model portfolios, but then some of these companies do charge up to 40 basis points TFN fees. Then you have to consider transaction charges, which might be higher on an NPS basis, and then also platform charges. So if you consider all of these fees, I think we can agree that even the NPS industry is massively overpriced. However, I think we can also agree that we have came a long way to drive down costs across the industry, whether it's NPS or funds, whether it's active management, active managers or index managers. Across the whole industry, we have driven down fees quite a lot. So what about transparency and accountability? How does the look-through benefit of model portfolio solutions enhance accountability and transparency in the industry? And I think, to be honest, this does make our job as model portfolio managers a bit more difficult, which is a good thing. Advisors are much more in touch with the underlying holdings or the underlying fund managers. This means that we as model portfolio managers need to have robust justifications ready whenever we are considering making changes to a portfolio. It's not the case that we might get pushback from advisors when making changes to a portfolio. I think it's a given. We will get pushback when making changes to a portfolio. And again, this is a good thing. It holds us accountable, and it works the other way around as well. If there are any red flags with the fund manager, we need to be able to justify why this fund manager are still in our portfolios. Now, there's some other factors as well that advisors are much more aware of when looking at model portfolios. Advisors are very much engaged in the fund expenses. They do see this on underlying platforms. They do look at the index replication method using in your index funds. They do look at fund track records, fund sizes, investor protection plays a major role, security lending programs. All of these factors are things that we do consider when we construct model portfolios, but the advisor on the other side are also very much engaged with them. So now I believe this same level of due diligence is being maintained within multi-asset funds. It's just the fact that advisors are more engaged with the underlying fund manager. And then finally, some advantages of the look-through benefits that we can add on is I think advisors might be able to pinpoint the source of performance or the source of fees in a portfolio. They can see where's your emerging market equities coming from. You can see your developed equities, your shorter duration fixed income, your longer duration fixed income. These are all different investment sub-asset classes which advisors can point out and see this is where our performance or our fees are being driven from. And then finally, I think it also helps to avoid conflicts of interest, just showing the underlying asset managers, showing that there's really no conflicts of interest. We are diversified between fund managers, etc. Then moving on to taxes. From a tax perspective, what's the main advantage or the main disadvantage of using model portfolios? And I think everyone would agree that the main disadvantage of model portfolios is the fact that we are not unitized. For CGT purposes, it would make rebalancing and switches much more efficient if we were unitized. However, because our ex-ante portfolio turnover is basically 0% per year, we do not trade very often, especially in Timeline. We are low-cost index managers. We don't expect to make any changes to our underlying portfolios. But that said, for a manager that does make many changes a year in its portfolios, the unexpected CGT events might not be desirable from an MPS solution. And I've made the point on the screen with showing discretionary permissions. And it is a fact that when you do run a discretionary fund manager, you do have the discretionary permission to make these underlying changes without the permission of the investor. And this can result in unexpected CGT events, which is not a good thing necessarily. Now, that said, the main advantage from an MPS point of view is the fact that we are not unitized. So the main disadvantage is also the main advantage. And an advantage of not being unitized is that we can customize portfolio changes to suit individual investor needs. For example, tax loss harvesting from existing funds. We can also run a customized decumulation strategy, and we can, well, I'll talk about this on the next slide again, but it is a functionality that we do have on the MPS side of the debate. Now, moving on to rebalancing or flexibility around our portfolios, I believe that we can all agree that flexibility is highly valued by most advisors in the industry, and this is something that carries a lot of value in the way that we manage our portfolios. Model portfolios, I think I've said, are more suitable for a tailored decumulation strategy. It's not necessarily something that we believe in. We believe staying invested actually provides the best long-term returns for an advisor. However, behavioral finance does come into play. Where an investor wants a decumulation strategy, we can prime harvest from fixed income, increase our cash allocations, and an investor does have the opportunity to withdraw only from the cash portion of its portfolio. Now, in terms of our Timeline advantage, I think where flexibility comes in, it comes into our rebalancing philosophy. So what we do at Timeline is we do not rebalance on an annual or quarterly basis. In fact, we do have a 10% tolerance-based rebalancing methodology. So basically what happens is, as an asset class drifts by 10%, we will bring the portfolio back to the strategic asset allocation. And our research, as you can see on the screen, just based on 30-year rolling periods over the last 100 years, have shown us that over an annual rebalancing methodology, a 10% tolerance-based rebalancing methodology provides about 7 basis points additional return if you take the last 100 years into account. Now, finally, in conclusion, I think we can all agree that it's not a one-size-fits-all solution. The considerations above simply demonstrate that there is not a one-size-fits-all answer to whether to use multi-asset funds or model portfolios. Financial advisors have choice, and the decision on whether to use MPS or funds is based on client requirements and suitability. Thank you very much.
Thank you, Laurentius, for a really interesting session. So last but by no means least, we have our final speaker for the morning with a presentation entitled The Summer of Discontent. It's going to be quite a finale. Kevin Doran is Managing Director of AJ Bell Investments. Let me set the scene. What happens if time travelers from the 1970s arrive in the modern day? They might be forgiven for wondering if they'd gone into the future at all. Industrial disputes, inflation, political instability, and divisive proxy wars in foreign lands, a recipe for uncertainty and policy concerns for investors. In this session, Kevin will take a look at the current landscape and provide some portfolio tools to combat the risks faced by politicians in the modern age. Ladies and gentlemen, hang on to your hats. Here's Kevin Doran.
Inflation, industrial action, a bond market in turmoil, a proxy war with Russia, and a Prime Minister clinging on to power. All feels like the summer that we've just gone through, the summer of 2022. But actually, it's also very reminiscent of the 1970s, where Sunny Jim and the winter of discontent disappeared off to Barbados to sun himself and his compatriots in his sunny climes. And it does feel like very much like the 1970s. The 1970s were a culmination of politics, economics, and history all combining in order to create not just a winter of discontent, but a decade of discontent for investors. Indeed, if you have a look at the data within the London share price database run by the London Business School, the decade of the 1970s was the worst possible outcome for investors in real terms that UK investors have ever envisaged. And so as we go into a period where we are seeing higher inflation, and it was inflation that led to those poor real returns for equities and bonds, the question is history about to repeat itself? That's what we're going to look at today. But before we do so, I think it's really important. You can't look at economics in isolation. You can't look at history in isolation. You can't look at politics in isolation. The three come together to really kind of play off each other. And that's what we're going to do. We're going to take a look at what's going on in politics and economics at the moment and contrast it with what's going on in historical terms. Now, if you are a UK investor, there's a number of risks that you face when you're running multi-asset portfolios. But what I'd like to do is focus on the two single biggest risks that are faced by UK investors right now. That's not necessarily the two people you see on the screen, but they represent the two biggest risks faced by UK investors. And that's a bond market in turmoil, where government bond yields are on the increase, and also a nation which has the highest current account deficit in the whole of the G20. A current account deficit worse than Turkey's international position. And that all culminates and comes together nowhere best demonstrated than when you take a look at the gilt market. And that's what we're going to focus on today. So what are you looking at here? You're looking at the shape of the UK government bond market at the end of the first quarter 2022. It's the latest data available for which we have ownership statistics. At the end of the first quarter 2022, the UK government had a market valuation on its debt of £2.5 trillion. That's 100% of GDP. And when governments get into debt to those sorts of levels, 100% of GDP, they always default on their debt. Now, I appreciate that's quite a hyperbolic statement. The government will default on its debt, but let's decompose that and think about what a default actually means for your creditors. When a government defaults on its debt, in the traditional sense of you don't get your money back, you as a creditor have had your purchasing power permanently impaired. And so if we think of default as a permanent impairment of your purchasing power, there's another two ways in which a government can default on its debt. The first one is if it owes money to foreign creditors, it can devalue its currency. That's a permanent impairment of the foreign nation's purchasing power. And alternatively, if it owes money to the domestic population, you can inflate away your debt. And I'm going to argue that both inflation and devaluation of the currency are your biggest risks that you face in portfolios, and are also probably unspoken monetary policy. So let's dive into that £2.5 trillion worth of debt. And you'll see there the big number, almost a third of all UK government bonds are currently owned by the Bank of England. That obviously came about via the QE programme, which is known in the technical term as the Asset Purchase Facility. Now, very recently, the head of the Bank of England said that they were about to go into a series of transactions where they would be selling down those bonds held in the Asset Purchase Facility. Now, slight tangent here. Now that they've told the market that they're selling those bonds, they ought to be accounting for them differently. And when you account for them differently, you should be valuing them on your balance sheet at the market price, not at the price that you paid for them, which is what you can do if you say you're going to hold them indefinitely. So now that we're in a world where the Bank of England is deliberately selling their positions, they should be valuing them on their balance sheet at market prices. I hate to tell you this, if the Bank of England has £6 billion worth of equity on its balance sheet. And so it would only need a 1% drop in the value of government bonds held on the balance sheet, and the Bank of England becomes insolvent. The Bank of England is insolvent, and it will require recapitalisation by the Treasury. And so here you've got an instance where the Treasury and the Bank of England are acting in cahoots. Let's look at the other owners of UK government bonds. Almost a third, so 30% of all UK government bonds are currently owned by foreign investors. We'll come back to that in a moment, but the insurance companies and pension funds tend to have fairly steady demand for UK government bonds, and that currently amounts to just over a quarter of all the bonds that are out there. Other financial institutions, as you and I, that's the asset management industry, where you've seen a drop in the demand for UK government bonds, given that yields have been falling, and monetary financial institutions are otherwise known as banks and building societies. And again, they've had a fairly consistent demand for the UK government bonds that are in existence. Now, Kwasi Kwarteng in his mini budget, and I appreciate on a day-to-day basis, the content of the mini budget keep on changing, but according to the according to the Institute for Fiscal Studies, the expected growth rate in borrowing from the UK government in the next 12 months will now be £190 billion. So there's new supply of £190 billion worth of government bonds coming to this marketplace. And the question I would pose is, who's going to buy it? Because if the Bank of England are no longer purchasing UK government bonds, other financial institutions such as ourselves may increase it, but we're certainly not going to increase our demand to £190 billion worth. The banks, insurance and pension funds don't need any additional money. The only people who are willing to potentially buy our bonds in sufficient quantity are overseas buyers. We are reliant upon the generosity of foreigners in order to finance our current account deficit and our budget deficit. And I would argue that the only way you can make people interested in those is increase the yields and also devalue your currency. That feels like unspoken monetary policy. Now, the consequences of the mini budget are not just restricted to the government bond markets. The government bond market sets the price of all credit-related products that are available to investors, and also sets the price of the rate set in the mortgage market. So what I want to do now is take a look at what's happening in the mortgage market and then reintroduce some politics back into our economics picture. Now, since the financial crisis, and we've had a successive lowering of interest rates, more and more people have looked to fix their interest rates on their mortgage at excessively low levels, such as the pace that 95% of all mortgages that are granted in the UK and are in existence in the UK at the moment all have a fixed rate of interest. And the rate that they're paying on those mortgages has been falling consistently for the past 15 years. Now, a typical mortgage in the UK has an LTV of around 75%, and it will be on a house worth about £250,000. So if you plug those numbers into the current, and I did this last night online, you plug those numbers into the current mortgage market, the lowest rate I could find for the 2-year fixed rate, 75% LTV mortgage was 4.3%. That's the lowest rate I could find. Rates of 5% and 5% plus are very prevalent in the marketplace. So if that's the lowest rate you can find, what does that mean for mortgage holders? Well, let's take a typical £200,000 mortgage. At 2% or just over 2% interest rates, the monthly payment that you would make on that is around £950. At 4.5%, that increases by £250 to almost £1,250. And the rule of thumb is roughly for every 50 basis points on top of that, leads to an extra £50 per month that a typical mortgage holder would have to pay. So now let's think of the politics associated behind that. There are 29 million households in the UK. 11 million of those households have a mortgage outstanding on their property. And 2/3 of those households have 2 adults living in the house. So if you start doing the mathematics on this, that's 15 million people living in cohabitation who have mortgages on their houses, and roughly 4 million people living by themselves with mortgages on their houses. That's 19 million potential voters who will, over the course of the next 2 years, see significant increases in their mortgage rates. This is a cost of living crisis, not due to energy prices, but a cost of living crisis foisted upon to Middle England thanks to higher base rates, higher mortgage rates, and higher government bond yields. Now, when we looked at the cost of living crisis due to energy prices, that was more predicated on people with low incomes. So people in the first, second, and third income decile, they were most hurt by the increase in energy prices. From a political point of view, that's not very nice, but they're also the people who are least likely to vote. Contrast that with people in the 7th, 8th, and 9th income deciles who do vote, and they're the people who also have mortgages. You've now got almost 19 million people who, thanks to your budget policies and thanks to your economic policies, are now witnessing an additional cost of living crisis through higher mortgage rates. And that brings a political dimension to what happens to interest rates going forward. So who are the people who set interest rates in the UK? Well, you can see a replay of the Brexit scenario coming out here. A bunch of unelected bureaucrats with no democratic process around them and no accountability to Parliament. Surely there must be a need, particularly in times of economic crisis, to have more sovereign control over the pace at which interest rates are set. Now, you'll all be familiar with the 9 members of the Monetary Policy Committee. These are the 9 members who sit on a regular basis and determine what the Bank of England's base rate is. And of course, everyone knows there are 9 members of the MPC. But actually, if you read the minutes of the Monetary Policy Committee, you'll see that not just 9 members attend, there are actually 10 members who attend the Monetary Policy Committee. And since September 2017, that 10th member has been a lady called Claire Lombardelli. So who is Claire Lombardelli and what does she do? Well, Claire Lombardelli is the Treasury representative on the MPC. And why would you have a Treasury representative on the MPC? Well, think back to the financial crisis. In March 2009, the Bank of England were given authority by the government in order to engage in quantitative easing, the printing of money in order to create new bank reserves. And it also used those bank reserves in order to accumulate, as you saw earlier, that £800 billion worth of UK government bonds. Now, I said before, that's been in place since March 2009, and Claire Lombardelli has been in her post since September 2017. So you might well ask the question, well, who was doing this between March 2009 and September 2017? Well, that would be Sir Dave Ramsden. So currently, of the 9/10 members of the MPC, there are effectively 2 Treasury representatives. The Bank of England has its independence in name, certainly at the moment, but I think the single biggest threat we face as we look into the next 2 years in particular, into the next general election, is the severe risk that the bank loses its independence. It's almost a political inevitability that the bank loses its independence, or in the very least, it has its inflation mandate changed. And who's responsible for that? Our new conductor. So Liz Truss has come in as our new Prime Minister. It's not been the most auspicious of starts for Liz in her role as Prime Minister. I'm recording this on the day of the Tory party conference, where Liz has just given her speech to the membership, where she says, whenever there is change, there is disruption. This is the Prime Minister willing to take tough decisions. Whether they're willing to also face down rebellion within the party remains to be seen. But if they are, and the party rallies behind it, I would argue that it's almost inevitable that the Bank of England either loses its independence or has its mandate changed. Whilst inflation is the unspoken monetary policy of the day, it's a possibility that leads to the actual monetary policy of the day. And that's a big risk to your portfolios, particularly in real terms, real rates of return on equities, real rates of return on bonds. Now, of the two, bonds are least equipped to manage this change. So at this moment in time, holding bonds and portfolios, even on the higher yields that you've seen over the past 3 months, remains a risky proposition. Sure, real interest rates have risen. Sure, bond rates have risen, but the real rate of interest on index-linked UK government bonds remains in negative territory. If you're buying index-linked bonds in order to protect yourself against inflation, you're guaranteeing to destroy your client's purchasing power. And if the past couple of months have shown us anything, it absolutely has demonstrated that index-linked government bonds are not a protection against inflation. Indeed, year to date, index-linked government bonds as a basket of securities are down about 1/3 year to date in an environment where inflation is currently running at 10%. Index-linked government bonds are not inflation hedges. Never have been, never will be. They are currently on negative real yields and are guaranteed to destroy your client's purchasing power. So there will be change. There will be disruption. The next 18 months will be significantly different in terms of political outlook as opposed to economic outlook, and it's the politics that are going to matter. The good news is this is all eminently forecastable and things that you can prepare your portfolio for. So the question is, what does a portfolio look like that is able to anticipate these changes and is able to position itself accordingly? Ladies and gentlemen, I give you the AJ Bell range of growth funds. And indeed, what you're looking at here is the balanced fund versus the Investment Association mixed 40 to 85 category. Consistent outperformance and indeed a growing rate of outperformance in the past 12 months, because the situation that we've seen over the course of the past 12 months, in our view, was eminently forecastable. Who wants to get on board?
Thank you, Kevin. That concludes our multi-asset seminar. We hope you found it useful. If you follow the feedback link that will automatically open when the webinar closes and tell us how we've done today, that'd be great. We really appreciate the feedback. It helps us shape future events, and we do appreciate a couple of minutes if you have them spare. Just a reminder, we will send out your CPD certificate and a copy of the slides over via email tomorrow. If you have any questions for speakers following today's session, please note them in the feedback form and we'll make sure that they are received and get the answers back to you. Recordings from today will also be available on the Info Centre, so please feel free to share those with any colleagues that you think might benefit from the content. For anybody who hasn't yet secured a seat, just to say we do have a few tickets remaining for Investival. We'll be back at the Shaw Theatre for our flagship event, and you can register by clicking the links in your CPD email. I'll be back at Investival again as your host. I really look forward to seeing you all in London. It'll be an action-packed day and night as normal, and I'm very much looking forward to it. So from everyone here at AJ Bell, thank you again for your continued support, and please keep safe until we see you again soon.